Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Asian stocks look set to trade cautiously at the open on this Monday in Asia as investors assess the pace of the economic recovery. Our next guest is still focused on inflation risk. Let's bring in Tony Monopoly, President and CIO of Columbus Asset Advisors. Thank you so much for joining us, Tony. So how successfully is the Fed at the moment walking that tightrope in trying to keep inflation under control but really not spooking the markets?
Well, you hit the nail right on the head, right? So as we look at this, we have the Fed telling us, look, inflation is going to be transitory. It's not something that we need to really be worried about. But as you were mentioning in your earlier segment on just the profitability of some of the basic material companies in Australia, clearly you're seeing material costs go up and also labor costs. So while we're not advocating to fight the Fed, I don't think many people have won that battle. We are saying that you need to look at some of the base effects, like both the inputs of materials and certainly labor, and that could make this transitory period maybe a bit longer than the Fed was hoping, and that's the question of, does actual inflation take root?
What do you think of the risk once the Fed starts moving? And not only the Fed, we have seen tightening moves coming from emerging markets as well, whether it's Mexico or signals from the BOK. Once we start seeing reduced monetary stimulus, emergency stimulus measures from governments as well, that this will actually impact those speculative trades like meme stocks and crypto as well.
Well, sure. So you hit, again, you're right on it, because what we have is there's been a lot of very cheap money available, and also the notion that central banks were going to be there to be the backstop, right? So if something went wrong, here's the next rescue package to the rescue to keep things going. So it's really, for us at Knights of Columbus Asset Advisors, we're very big fundamentally driven managers, and we believe that fundamentals matter over time. So overall, we do think that as the stimulus is taken away, you're really going to have to look at these individual companies from the bottom up to understand who actually can have cash flow generative earnings and who can continue to generate free cash flow. And maybe some of the meme stocks aren't going to fare so well in that type of environment.
What does that mean for the number of stock sales, secondary listings that we've seen from the likes of AMC and GameStop, right? Like, you don't blame, obviously, these companies for doing it and striking while the iron's hot, but is this just a disaster in the making for investors?
I'm very concerned that these companies, I had an investor, one of our clients asked, what did you guys think about AMC? And when you think about AMC in the middle of a global pandemic, are you really going to have several hundred people line up to be in a dark theater together while you're still trying to figure out, can I get COVID? So, as you said, I don't blame them for striking while the iron's hot and taking advantage of the ability to make these large secondary offerings. But again, I think for going forward and for serious investors, it's going to be awfully hard to want to buy into these if you don't see very solid earnings and a reason for these companies to be raising capital, and why you think it's going to be generative to their bottom lines. And we're just not seeing that in some of these names.
Tony, when you take a look at the stimulus, the tax cuts that a lot of families have that are clearly driving a lot of the pockets of reflation or inflation, if you will, things like Airbnb bookings and air tickets as the reopening happens, when does that start to tail off?
Well, look, I would tell you, I think with Booking, you mentioned, we happen to own that in our large cap growth fund. Pleasure travel has been picking up dramatically, and we're also starting to see anecdotally that business travel will pick up in the second half of this year and into the first half of next year. So we think this environment can do quite well, probably until the middle of next year. And I think for us, that's really going to see what is the new normal, if you will, with respect to travel, right? Are people traveling more? Are we getting back to business as it used to be? Is it 80% of what it was? But you're still coming off a very low base, particularly no base with business travel. So we think there's some opportunity there, particularly for a company like Booking.
Tony, great to have you with us. Tony Monopoly, President and CIO of Columbus Asset Advisors. Well, coming up on Daybreak Australia, Tesla hit by Chinese regulators. Beijing forces the EV giant to update nearly all of its vehicles delivered there in recent years. We have the details ahead. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Well, Bitcoin is in focus again after its latest regulatory hit, the UK banning crypto exchange Binance from operating there, although the company says it hasn't actually launched its UK business and services on its website and won't see a direct impact. Let's bring in our cross-assets team editor, Joanna Ossinger. So, Joanna, obviously the reaction from Binance was a little bit of a shrug, saying, look, it's kind of irrelevant right now, given that they're not in that market yet. But does this just add to the overall bearishness around what happens with Bitcoin and Bitcoin trading?
It's both good and bad, right? Because it injects uncertainty into the situation overall for the crypto market. But there are a lot of people who say it's actually good in the long term because as crypto gets more regulated, it will make people feel better about the potential for investing in there.
What are we seeing in terms of the price action? Because we continue to see some upside and perhaps getting away from that $30,000 level.
Yeah, so it was able still to hold, Bitcoin was able to still hold above 30,000. I think now it's just about 33,000 or so. There have been some strategists who've been saying that there's a bearish setup. JP Morgan's Josh Younger was saying this weekend that it looks like institutions are not really buying and that recent sales went from just taking profits to actually covering losses. So he sees a bit of bearishness in there, but also said it looks like the market's starting to heal. So it could be something of a bottom at this point.
Our cross-assets team editor, Joanna Ossinger, they are watching for us the crypto markets. Let's turn to China. Profits of industrial companies there continue to grow at a solid pace, but slower in May as base effects from revenues crushed by the pandemic abated and rising costs hit small businesses. Global economics and policy editor Kathleen Hayes is here with the details. And Kathleen, we've been really talking about that uneven recovery that we continue to see in China. What are these numbers telling us?
They're telling us the recovery definitely is in place. It definitely continues. The latest year-over-year numbers may not be quite as blazingly strong, but remember, we're comparing this year to last year when industrial profits, along with a lot of other aspects of China economies, other economies around the world got crushed. So the number we're getting for the latest month is 36.4% year over year in May. Back in December, you can see that the far left, the number was 15.5 up to 20 and change in November. We skip a couple of months and go to March. Look at that. Again, comparing this year March, last year March, 92% year over year, 57% in April. So when you get to 36.4, it's still a strong number. It's the difference in comparing over year. But when you look inside of the numbers for this month, what's also important is that profits of China's smaller companies are now rising slower than the pace of bigger companies. We're also seeing that rising commodity prices are helping upstream companies, we call them, like raw material producers. But if you're a downstream company that has to buy things that are driven in large part by commodity prices, that's one of the things that is squeezing your profits, particularly for smaller businesses.
In terms of the early indicators that Bloomberg has a look at, what does that tell us about where the expansion goes from here?
Well, it's a very interesting report. It looks at 8 very important indicators, and what it shows is the recovery is stabilizing in June. It's still solid. It's still strong. It's just kind of leveling off in terms of the strength of the gains. In fact, it's signaling, if you want to look over the whole year, that yes, China's economy should grow about 8.5% in 2021. That's a very, very good number. Again, it's a post-pandemic number, but still strong. Business confidence is one of these indicators. It's a survey of businesses, more than 500 in China, done by Standard & Chartered. It is still coming in at June at the second highest level since the COVID outbreak, a very strong number. If businesses feel confident, there must be a reason why things are looking good to them. One more thing to look at quickly, China PMIs, we'll be getting those tomorrow. They are again stabilizing. What you're seeing here is we saw that big drawdown last year, that big drop, but now we're back up to some pretty solid numbers. May for the manufacturing number, the white line was at 51. It's supposed to go down to 50.8. That's still above 50. It's still growing, just not quite as fast. Services were at 51.0. They're supposed to, by 55 and change, they're supposed to ease a bit. But still, we're going to get from the PMI the same message. Things look good. If you look at exports, if you look at the producer prices, the factory gate numbers, they're strong. All are indicating, Heidi, that China's economy recovers. It may not be as blazing, but it's still going strong.
Our global economics and policy editor, Kathleen Hayes there. Well, Tesla's aspirations in China were dealt a major blow over the weekend after the government ordered that almost all the cars it sold in the country to be fixed to address a safety issue. For more, let's bring our markets co-anchor Tom McKenzie in Beijing. I suppose the upside is that a fix for Tesla like this is pretty easy in terms of a software update, but what do we know about what happened here?
Yeah, Heidi, I think that's a really important point. But we're talking about 285,000 cars or thereabouts, and importantly, all the deliveries, almost all the deliveries of the Model Y, which has been delivered in China since January. And it's seen by Elon Musk and those at Tesla as being absolutely key to the driver of future growth here in China. But you're right. Look, this is a software fix. The regulators said that the concerns were that the autopilot system could be turned on automatically. That could lead to problems, but it can be updated remotely. Tesla say they're going to do it for free. I think the bigger picture is that this is the latest setback for Tesla in its second largest market. You had that protest, of course, that we remember at the auto show earlier this year. You've had a number of crashes here that have drawn some concern and scrutiny. And then you've had security concerns around its cameras and some departments, government departments, looking at whether or not they're going to allow Teslas into certain compounds because of security concerns. So again, it's just a reminder that this has been something of a challenging year for the company, again, in its second largest market. Though it's worth pointing out that in May, they did see a pretty solid number in terms of deliveries here.
Yeah, especially after you saw all of that support coming from authorities when they were setting up their factories in Shanghai, right? But let me turn over to Europe, because, Tom, a Chinese battery maker is also tying up with Renault.
Yeah, it's a battery maker. It also is a wind turbine maker as well. It's called Envision. They're investing about $2.4 billion in northern France. And you're right, this is a tie-up with Renault. They're helping to provide the batteries for an affordable range of EVs from that French automaker. They say they're going to be creating about 2,500 jobs in France. But importantly, they also say that they're looking for partnerships with cars beyond Renault. They say, look, France is strategic. This important tie-up with Renault is central to them, but they are looking for tie-ups with other automakers. And it's a reminder that this investment, despite the frictions between Brussels and Beijing, this investment from Chinese companies in Europe does continue. And in the EV space, where this demand for batteries is very hot, China is playing a major role.
What lessons can be learnt then from this EV experience in China?
Well, there's one particular city, it's a city of about 4 million people called Liuzhou, where they have about 30% of all the cars that have been delivered there in recent years are electric. And this city is seen as something of the capital of electric vehicles in China. It probably trails only Oslo in Norway in terms of electric vehicle take-up. If you think about 30% of cars in this city are electric, that's about 5 times China's average. About 4.5% of all cars, by the way, globally delivered are electric. So it's way above that. But what they've done is, crucially, they have a local car maker, the Shanghai automaker with GM and Wuling have created this $5,000 electric vehicle. You see pictures of it on the screen there. So you have an affordable, cheap EV that is easily accessible, but they've also done things like test drives. They've given out cash incentives for drivers who drive over a certain distance. They have charging points everywhere and a lot of support from the local government, free parking as well. So it's seen as something of a template for some of the auto strategists here for how other cities, other jurisdictions outside of China can encourage that pickup and that take-up in electric vehicles.
Everyone will be watching. Markets co-anchor Tom McKenzie there in Beijing. And here's now a quick check of the latest business flash headlines. United Airlines is poised to buy more than 200 Airbus and Boeing jetliners in one of the largest deals in its history. Sources say the U.S. carrier is looking to revamp its single-aisle fleet with more efficient planes. United is expected to buy more than 150 Boeing 737 MAX jets and over 50 Airbus A321 NEOs. Sources say UBS will permanently allow as many as 2/3 of its employees to adopt a hybrid model of working from home and the office. CEO Ralph Hammers is said to be leading the charge in a bid to be more competitive in recruitment compared with U.S. banks. UBS will also consider working arrangements based on roles and locations. No date for a return to the office has been set. Coming up, we discuss Australia's virus situation with one of the country's most prominent infectious disease physicians and microbiologists. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
You're watching Daybreak Australia. I'm Vonnie Quinn with the First Word headlines. Australia has extended virus restrictions as it fights its latest wave of infections. Greater Sydney's 5 million people were put into lockdown on Saturday, while the Northern Territory, Queensland and Western Australia have also imposed new curbs. While case numbers are relatively low, the flare-up puts more pressure on the Morrison government to step up a vaccination program that has lagged many other developed nations. Boeing's updated version of the long-haul 777 jetliner is facing new safety concerns, with U.S. aviation regulators requiring more testing now before certification. The FAA is demanding Boeing address multiple shortfalls, including flight control software that apparently triggered the plane to move without pilot input during a flight. The FAA says it doesn't expect certification until mid to late 2023. UK Prime Minister Boris Johnson has moved to re-establish his government's authority after the Health Secretary resigned for breaking his own pandemic rules. Matt Hancock quit late Saturday after he was caught embracing a senior aide in his office in breach of the social distancing guidelines he helped to create. Johnson had initially fought to keep Hancock in his job.
I understand the enormous sacrifices that everybody in this country has made, that you have made, and those of us who make these rules have got to stick by them, and that's why I've got to resign. I want to thank people for their incredible sacrifices and what they've done.
Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Vonnie Quinn. This is Bloomberg.
Millions of Australians are under new curbs to fight a COVID-19 outbreak. The restrictions span the country, including a 48-hour lockdown in Darwin, another already underway in Sydney. While the count of the new local cases detected on Sunday was comparatively low, officials have warned that that tally will climb. For more, let's bring Peter Collignon, who's a member of the infection control expert group that advises the Australian government. So, Peter, some 18 months into this pandemic, we're here again, and I think a lot of Australians are kind of in disbelief at how well the initial outbreak, last year was handled, the victory, if you will. Is this because the vaccine rollout was flubbed? Is this because the chain of infection control, starting from hotel quarantine, hasn't been handled properly?
Well, I think all of the above, but to put this realistic, you can never make your risk zero. And the Australian hotel quarantine system and restricting people coming in has been very successful. I mean, it decreases the risk by probably a factor of 100, but it doesn't make it zero. So these leaks are not unexpected if you have people coming in. We often find faults that need to be improved, and again, this is a situation with this one. But realistically, to maintain elimination indefinitely is not realistic. We have clusters that, previously we've got on top of every one of them, and I would think we can do that again. And relative to the rest of the world, I mean, in Sydney they're having 30 new cases a day now, and they've locked down the city for that. We'll see whether they needed to go that far, or whether other restrictions with good case finding would have worked, but that'll become evident in the next week. As far as the vaccine rollout is concerned, yes, we are behind compared to other countries, but equally we haven't had transmission of any note in most of Australia other than a year ago in Melbourne, and even by world standards that was low. So we do need to get people vaccinated. The good news is the people who are most likely to die, that is people over the age of 70, at least 2/3 of them have had their first dose and a lot their second, and in nursing homes probably 80 or 90% have already had 2 doses. But it'll be quite a few months, and supply has been the issue, but we're manufacturing the AstraZeneca vaccine in Australia. There's 1 million doses a week should be available. There's about 200,000 to 300,000 of the Pfizer vaccine that's coming in, but in a couple of months' time there'll be much greater supplies of Moderna, Pfizer. So currently we're getting 800 to 1,000 to 1 million people vaccinated per week. We need to up that, I think, to 1 million people per week, and when we get more supplies in a couple of months' time, we need 2 million people vaccinated per week, because we need to get 70 to 80% of the adult population vaccinated, fully vaccinated. That is feasible by the end of the year, and by September, October, when our danger period is over, because winter is, the big danger period, we'll be in a much better position. But for the next 3 months, we are going to have to live with restrictions of some degree, in my view, if we want to keep control of this.
So you've talked about complacency as the biggest issue going forward. What does that mean when it comes to potentially this being a seasonal thing? Does a mask mandate, social distancing restrictions need to stay in place indefinitely?
Well, Well, I don't know indefinitely, but I think at least for the next 12 months. I mean, I think we, you know, in countries that have definitive seasons, and that's most of Australia, winter is where every virus transmits more often. And if I look at the Northern Hemisphere and what's happened so far, that's the case with COVID as well. I mean, the big advantage once we get large percentages of the adult population vaccinated, and particularly those over the age of 70, because that's where most of the deaths occurred, this, to some degree, will turn into what influenza is every year. We see lots of deaths every year from influenza. We can do better, I think, with influenza as well. We need to do a lot of things. You know, keep away from others when you're sick, keep distance, in winter keep the numbers down, all those sorts of things. So a lot of the rules were put in place for COVID. I think we need to continue for a little while longer, you know, at least a year and probably longer, because lots of other infections spread exactly the same way and do cause death and suffering. And if we can, not for a lot of inconvenience and cost, continue to do that, particularly in winter and particularly when you're inside in air-conditioned, situations, then we should continue to do them. But we've got to temper it, and it's got to be commensurate with the risk at the time.
Especially as you continue to have these vaccinations rolling out in a very slow pace. What happens with these variants? Because with the conventional strains, the idea was that if you get 70% of the population vaccinated, then you would reach the so-called herd immunity. Is that the case with these other variants, like the Delta one that's super infectious?
Well, I don't think we know the answer to that. You know, that'll be data as it unfolds. The good news about the Delta variant, if you look at the UK data, once you've had 2 doses of the vaccine, you decrease your risk of death and getting into hospital by over 90% for hospitalisation and probably 95% for death. So that's very good. Now, I don't actually think these vaccines are going to stop all spread, so it really depends what you mean by herd immunity. I think what the really high vaccination rates mean is you have a lot less spread than if you don't have people vaccinated, probably by a factor of 4 or 5. But you don't get zero spread. But what you really do is markedly decrease the consequences of these virus spreading, because people who are particularly vulnerable just die much less often. Now, they might get a mild illness and you spread it on, but you know what we're trying to do predominantly, in my view, is stop people dying and stopping them getting into hospitals. And so far, at least the Pfizer vaccine and the AstraZeneca vaccine, based on data, particularly from England, but elsewhere as well, are very, very effective at stopping you dying. And that goes for all the new strains, including the Delta strain as well.
So when it comes to here in the U.S., we really have seen abundant supplies, but many people not wanting to get vaccinated. The Arkansas governor talking about conspiracy theories about the effectiveness of vaccines, leading to more people just not getting the shot. When it comes to public policy, how do you fight that? What do you need to do?
Well, look, I think you've got to convince people by various means, and this is where you need everybody from just not scientists. You need, you know, people in the arts faculty. At the end of the day, look, all vaccines, all drugs have side effects and rare side effects. But the benefit of the vaccine, particularly for those who are older, just so obviously outweighs the downsides that, you know, if you're older, you know, if you're above the age of 50 and you don't get vaccinated, you really are putting your life, you know, up for grabs when you could, you know, basically stop that from happening. So I think we really need to convince people of that. I think one of the problems we've got in society, we want solutions with absolutely zero risk. Well, that's not true for any drug or vaccine. These so far are very effective vaccine, much more effective than any of us would have thought a year ago. You know, 90% plus is preventing you dying and coming into hospital. We would have been happy with 50% a year ago. So these are very effective. Yes, they have side effects. The AstraZeneca one causes these clots, as the Johnson & Johnson. But, you know, think about it. If you're an 80-year-old and you get COVID, you've got a 1 in 10 chance of dying versus about 1 in a million, 1 in 2 million chance of dying with the AstraZeneca vaccine from a clot. The benefits so far outweigh the risks that we don't get it right. And a lot of things that are much more risky we seem to ignore for other drugs and medicines we take. You know, if you like, the bad publicity, so it gets much more prominence than the good news. So somehow we've got to change that, because overall vaccination is the only way out of this. We need as safe and effective vaccines as possible. Some of them might be able to be improved, but, you know, so far we're in a much better position now than any of us would have thought a year ago with the amount of vaccine we've got available and their efficacy and their overall safety.
Reminds me of plane crash news, right? Where you have so much focus on the bad things when it rarely happens. Peter Collignon, thank you very much for joining us, Australian National University Medical School professor. Now, virologist Danielle Anderson was the last and only foreign scientist at the Wuhan Institute of Virology, a place that's become a flashpoint in the search for what caused the worst pandemic in a century. She spoke to Bloomberg about conditions there.
And there was no chatter of anything. Scientists are gossipy and excited. So, yeah, nothing strange from my point of view going on at that point that would make you think, oh, something's going on here.
Let's get more from healthcare reporter Michelle Cortez, who wrote Bloomberg Scoop story. Michelle, tell us a little bit more about this story and what are your key takeaways from this conversation?
So there has been a lot of controversy surrounding the Wuhan Institute of Virology, with some implications and allegations that perhaps COVID-19 emerged from that lab, either perhaps something that was intentionally created there or someone unintentionally infected who then carried it out to Wuhan, which of course is where we all first learned about the coronavirus, and the outbreak spun off from there. Well, Danielle Anderson was actually in that laboratory in November of 2019, and so she was on the ground and saw what happened there. And what she's saying is that what she saw doesn't look at all like what she's been reading about in the news media and some of these allegations. She says that the lab was very rigorously controlled. She had to go through 45 hours worth of training in order to be able to work in it at all. Then you have to take a round of 5 different tests in order to operate there independently. She said that she was not ever sick with any kind of a virus and was not aware of anyone else in the lab. And of course, now we know how transmissible this virus is. And certainly in Wuhan, where they were building entire hospitals to handle all of their patients, you would have perhaps expected that some of the people in the lab would have become infected had it been circulating there. So she's saying she does not think that it was originated in that lab at all. It is possible that it could have come from there because they do work with pathogens, and it could have somehow come about. She thinks that's within the realm of possibility, but thinks that the likelihood is very low.
It's very interesting because she says she's not naive, right, in terms of the discussion and the controversy that's still flowing over the origins of this. But the fact that, she says that she can't write it off, does that just give further credence to the cause that a thorough investigation needs to be had into, all of the possibilities?
Absolutely, I think that that's the case, and I think that that's what she's saying as well. I don't think it's giving credence to anything that's problematic. It's just an acknowledgement of the fact that something catastrophic happened to the world, and we don't know why. That's undeniable. Everybody knows that. We don't know where this virus came from. There's a lot of theories out there, some very scientific, some conspiratorial, but we don't know the answer. And so I think that anybody who has any type of a rational mindset would want to know the answer to this question. So what she is saying, what many scientists are saying, is that we need to get to the bottom of this, but we need to do it through an open and transparent way that's not casting aspersions on somebody, claiming allegations of people doing inappropriate things. What we really need to do is start looking at it from every different angle to get to the bottom of it. We need to know that not only so that we know what we've been through and what caused it, but in order to stop the next pandemic from happening as well.
Bloomberg healthcare reporter Michelle Cortez. Well, coming up, we highlight work being done to build a sustainable future, Bloomberg's new economy catalyst. And we kick it all off with South Australian Senator Sarah Hanson-Young telling us how she plans to tackle Australia's divisive climate policies. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You're watching Daybreak Australia. Time for morning calls ahead of the Asia trading day, focusing on energy this Monday morning with Brent trading little change after a 3-day advance. Now, over at JP Morgan, they forecast that Brent will average about $76 a barrel in the third quarter to average $80 in the fourth quarter. This as they have boosted their global oil demand forecast for this year by 200,000 barrels per day. This due in a large part to Chinese demand. Also, they see supply staying tight at about 300,000 barrels per day, lower than initially forecast, given there's weakness outside of OPEC and the U.S. And flipping the board, after the U.S. imposed a ban on solar products made in Xinjiang, several analysts see limited impact on the wider industry, given the U.S. accounts for a small amount of China's solar exports. And Morgan Stanley not anticipating that there will be supply shortages for the industry at large, Sherry, given that buying can be adjusted. And so any advantage for players like First Solar, that will likely be temporary. Sherry.
Right, so on Wednesday, Bloomberg will host its first New Economy Catalyst event, and Heidi, the sessions exploring and debating what's next in the fields of climate, right? Agriculture as well, biotech, e-commerce, space, and digital money.
Yeah, and it's very timely as we start to look in the post-pandemic world and the disruptions and changes that need to happen. And here in Australia, Sherry, of course, climate change denial continuing to be one of the strongest forces in Australian politics. Our next guest is seeking to change that dynamic. She's also a keynote speaker at the New Economy Catalyst event at Bloomberg. Australian Senator for South Australia, Sarah Hanson-Young, joins us now from Adelaide. Senator, wonderful to have you with us this morning. We really do appreciate your time. So even just in the last couple of weeks alone, there's been a number of developments that have been, again, negative for anyone who's concerned about climate change and emissions in Australia, the reappointment of Barnaby Joyce as the Deputy Prime Minister, and of course at G7, just the growing isolation that Australia finds itself in on climate change inadequacy, if you will, on policy. How do you change this given the nature of politics here?
Well, thank you so much for having me, and it's an absolute honour to be part of this new program facilitated by Bloomberg, because the world's challenges are huge, and we need to be thinking not just what happens in the normal election cycles, but what is happening over the next decade and decades to come. And you're right, here in Australia, we have some of the most divisive political debates about climate and the environment. And one of the worst parts of this is it is so short term. So, of course, we're on the brink of an election being called very soon, and we've got the conservative wings of Australian politics really blocking those ambitious targets that we need in order to reduce pollution and to phase out fossil fuels and to get on board the clean, green future and transforming the economy. Look, you know, you could be forgiven for thinking it's all doom and gloom here. Of course, with the federal government and Barnaby Joyce being elected as Deputy Prime Minister, who, of course, is self-confessed as not really caring about climate change or climate science, and being putting himself forward as a big friend of coal. But on the other side, we have state governments and state premiers of all political persuasions taking stronger and stronger action on climate and really forcing the policy debate here in Australia. They've done the same thing when it's come to how Australia's responded to the COVID pandemic. It's really been the state governments who have led the health response. And I think what we're going to see now is state governments and those minor parties really driving the change that we need and forcing the federal government's hand.
Is there also a concern that Australia's investment profile will suffer? Because we've had that bruising report from the likes of Rebecca saying that the risk profile of Australia for not doing anything about climate is increasing. Does that sort of money and pressure talk to the government?
Yes, absolutely. And at this point, it's been kind of brushed aside and no one wants to talk about it at a federal level. But yes, that pressure is coming and it's coming really hard. We know that those talks of restrictions on trade negotiations are not just a veiled threat, that it is actually going to be something that is starting to force themselves into negotiations with Australia and other countries. Obviously, the EU has already raised concerns about Australia's level of ambition and meeting properly and genuinely Paris targets, for example. And this next round of negotiations as we lead into the COP meeting, I think that pressure is only going to come harder and faster. It was very interesting over the last few weeks seeing those decisions come out from governments who went to the G7 and the lead up to that about putting on the table targets for 2030 and 2035. Because here in Australia, the federal government is desperate to keep the conversation about 2050, when actually what we need to be talking about is what happens in the next decade. And I think those trade negotiations are really going to force that.
Here in the U.S., we had more coal plants shut during the Trump administration than we did during the Obama administration, just because we had a lot of movement by localities, by states. What are you seeing on the ground if the federal government is not doing much?
Well, what we're really seeing is business now chomping at the bit, really forcing a conversation about where investment should be flowing. And it's quite clear that there is no money left in expanding coal-fired power here in Australia. The problem we have is that there is some businesses who are really digging in deep, digging their heels in deep on an expansion of gas. But of course, that puts us in a really tricky position when Australia goes into world forums, like we will at the end of the year to the COP in Glasgow. You can't on one hand be talking about reducing carbon pollution and on the other hand expanding the gas industry and gas extraction here in Australia. So look, the clean energy and the renewable energy sector here are doing well, but they're doing well in spite of Australian government policy.
So what we've gauged is that Australian voters want progress when it comes to climate change on emissions targets. They don't want a carbon tax, though. How does that equate as we head into potentially an election in sight? Is climate going to be a key issue? Because, previously we've seen it really not, I guess, matter by the time you get to the polling booth.
I think this is going to be a really interesting election. Over more and more, opinion polls are saying that Australians are frustrated and worried about the state of the climate and the environment. Only last week, a massive new survey of the public through the Australia Talks program, the ABC, was showing 81 and 74% of Australians worried about climate action, worried about climate change, and want the government to be doing more. Similarly, statistics in relation to their concern about just the state of the environment and whether we're doing enough to protect things like water security, biodiversity, our native animals. All of these issues are starting to raise their head again. Depending, of course, when the election is, there is some talk that the election will be towards the end of this year. That's going to come right up against the push for Australia to lift our ambitions at the Glasgow conference. So I'm hopeful that this election, climate will be on the agenda more than ever.
When it comes to the adoption, the more widespread adoption of EVs, there's been heavy criticism for the states. Federally, it's just a hodgepodge of policies, some incentivizing, others, deterring, it seems. What's the work to be done there to get adoption, to be mainstream?
Look, the electric vehicle discussion in Australia is one that is really contested right now. And you're right, there is differing views. We've got a federal government who just doesn't really want to talk about it, doesn't think it's important. There's no standards that would incentivise electric vehicles. But then we've got some states, like the state of New South Wales, which is traditionally a conservative government, actually, rolling out the most ambitious plan and incentives for electric vehicles, which is really good. There's talk of similar types of programs running through other states now. Of course, there is always this discussion about how much road users should contribute. So in Victoria, the introduction of a road user tax has been bad news for electric car drivers. But I think with a strong campaign and as the public start to see the benefits of incentives rather than disincentives, we'll start to see state governments having to change their policies too.
Australian Senator for South Australia, Sarah Hanson-Young. We'll have more guests from the Bloomberg New Economy Catalyst virtual event. Catch an exclusive interview with one of India's biggest social commerce players. Meesho CEO Vidit Atre is on Bloomberg Markets later. That's it for Daybreak Australia. Daybreak Asia is next. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have many friends.
oil. Welcome to Daybreak Asia. I'm Heidi Stroud-Watts in Sydney.
I'm Sophie Kamarudin in Hong Kong. We're counting down to Asia's major market opens.
And good evening from Bloomberg's World Headquarters in New York. I'm Sherry Ann. Our top stories this hour. Cryptocurrency surge as markets shrug off regulatory concerns. Investors buoyed by tweets from one of Mexico's richest men who says his bank is on its way to accepting Bitcoin. China's industrial profits slow amid rising costs, but the economy is showing signs of a more balanced expansion. And Australia warns of a virus surge in Sydney as millions grapple with increased curbs. The state government now rushing to finalize a rescue package for businesses.
All right, let's see how we're setting up for the start of this trading week here in Asia. So, what are you watching?
Well, Heidi, after a 4-day gain for Asian stocks, we saw the Kospi hit a fresh record high on Friday. We are seeing little moves for futures in Asia, while Kiwi stocks are under pressure, off 0.5% on the NZX 50. And we're seeing the Kiwi and Aussie dollars on the back foot. This as virus curbs have been imposed on Sydney, Darwin, and Wellington. Now, we have New Zealand officials saying that they are not out of the woods yet, but over at Bank of New Zealand, analysts there saying they expect the RBNZ will dial back QE in the coming months in preparation for tightening. And we are seeing markets pricing in for more than 50% chance of a rate hike from New Zealand in November. And with that, pulling up the chart on the terminal, we are seeing policy divergence widen with central banks in the UK, Canada, South Korea, and others among those signaling stimulus exits. And we do have EM economies leading that policy turn, while the likes of the ECB and the BOJ are signaling that they will likely keep steady. But overall, Sherry, a gradual tightening shift is expected. JP Morgan economists predicting that global rates will rise fractionally through the end of the year, just to 128 from 127. Sherry.
Yeah, and of course, the key question is what happens to market volatility in the meantime, right? Because we're also watching Bitcoin in focus after its latest regulatory hit, the UK banning crypto exchange Binance from operating there, although the company says it hasn't yet launched its UK business and services on its website and won't see a direct impact. Let's bring in our cross-asset team editor, Joanna Ossinger. Joanna, so we continue to see this diverging views when it comes to cryptocurrencies. This latest on the crypto crackdown, but at the same time, Mexican billionaire Ricardo Salinas Pliego now endorsing the asset.
Right. Well, and anytime you have something where someone says they're looking to further adoption of crypto, that does cheer the sector. And actually, regulation is not necessarily bad for it because it can encourage more people to get in. But we did have this notice from the UK this weekend about a Binance affiliate. And Japan is also cautioning on Binance as well. So regulators are definitely looking at the exchange system at this point.
So this is kind of incremental, right? What does it mean towards broader regulatory, the outlook for the crypto industry?
It could actually be beneficial in the long term, because if you have these regulators coming in and saying what can be done and implementing protections, there would be a huge change for the industry. So it's near-term uncertainty, but it could also encourage institutions and individuals to get in if they feel it's safer and they're more protected.
And of course, the China angle continues to be big. This is what we heard from the chairman and CEO of MicroStrategy when it comes to the exodus that we're seeing from the country.
Primary dynamic is the China exodus. There's a forced and there's a rushed exodus of capital and mining from China that was a bit of a surprise that kicked off in May. And that's driving the dynamic in the market right now.
How much of this is already priced into the market, Joanna?
It is somewhat priced in. I mean, Michael Saylor is very bullish on Bitcoin, so he's probably going to take an optimistic view. But there is a lot of uncertainty about just how far China is going to go on this crackdown, what exactly effect it's going to have. And some of the mining that's been cracked down on was actually green mining, like hydropower. So it could make Bitcoin a little bit dirtier in the near term, but we'll have to see how it shakes out overall in the global market.
Our cross-assets team editor, Joanna Ossinger, they're always on the fun Bitcoin beat. Let's get you to Bonnie Quinn, who's got the first word headlines now. Bonnie.
Heidi, thank you. President Joe Biden's infrastructure deal is back on track after he clarified comments that threatened to derail the bipartisan agreement. Republican senators who signed on to the deal were alarmed that Biden seemed to be making a veto threat by linking the $579 million infrastructure plan to a larger tax and spending bill. However, they say negotiations can move ahead now that he clarified his remarks.
It was a surprise, to say the least, that those two got linked. And I'm glad they've now been delinked, and it's very clear that we can move forward with a bipartisan bill that's broadly popular, not just among members of Congress, but the American people.
Boeing's updated version of the long-haul 777 jetliner is facing new safety concerns, with U.S. aviation regulators requiring more testing before certification. The FAA is demanding Boeing address multiple shortfalls, including flight control software that apparently triggered the plane to move without pilot input during a flight. The FAA says it doesn't expect certification until mid to late 2023. UK Prime Minister Boris Johnson has moved to re-establish his government's authority after the Health Secretary resigned for breaking his own pandemic rules. Matt Hancock quit late Saturday after he was caught embracing a senior aide in his office in breach of the social distancing guidelines he helped to create. Johnson had initially fought to keep Hancock in his job.
I understand the enormous sacrifices that everybody in this country has made, that you have made, and those of us who make these rules have got to stick by them, and that's why I've got to resign. I want to thank people for their incredible sacrifices and what they've done.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Bonnie Quinn. This is Bloomberg.
Still ahead this hour, we hear from the CEO of one of Singapore's largest privately owned construction companies. Michelle Yeong discusses diversifying the family empire in our weekly look at Generation Next. But coming up, Moody's Analytics says the recovery in China is maturing and poised to slow. Katrina L. joins us just ahead. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Farrow. This is Bloomberg Real Yield.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Back to one of our top stories, and millions of Australians are now under fresh virus curbs. The new restrictions span the country, including a 2-week lockdown in Greater Sydney and a snap 48-hour shutdown in Darwin. Officials are also warning that the case count could rise in New South Wales, where 30 infections were reported over the weekend.
I also do want to foreshadow that
given how contagious this strain of the virus is, we do anticipate that in the next few days, case numbers are likely to increase even beyond what we've seen.
Bringing our Australian government reporter Jason Scott, who joins us now from Canberra. So, Jason, there is concern, obviously, that the outbreak is moving beyond Sydney's borders.
Yeah, that's right, Heidi. I mean, Sydney went into lockdown last Friday, and, you know, while the count of new cases there has been comparatively low to the rest of the world, so in 30 yesterday in New South Wales state, officials are fearful that, you know, the highly contagious variant, the Delta variant, is spreading amongst that community and is warning that tally may climb and will likely climb. We're expecting an update of the numbers this morning. I guess even more concerning is what you alluded to, that, you know, now there are reports of the virus popping up in other parts of the continent, which mainly seems to be spreading through plane travel. Yesterday in Darwin, which is thousands of kilometres away from Sydney in the country's north, it entered a 2-day lockdown following the detection of 4 new local cases in the region. And that cluster was linked to a worker at a new Montcorp gold mine in the desert, basically, in central Northern Territory. Hundreds of employees are now in isolation there. Elsewhere in Queensland state, has announced 2 new local cases yesterday and imposed additional curbs. And restrictions like mask wearing are now being introduced in Perth and Canberra for the first time. Western Australia had a positive result there. So there's real concern that this Delta strain may be spreading too fast to contain.
Given that that's the case, what does it mean for the economic and social impact that you guys are seeing?
Yes, well, that's to be played out. I mean, there's no doubt that there'll be a strong economic impact, particularly if these lockdowns are prolonged and the virus spreads. One area of focus today will, of course, be the financial market reaction. Australian shares and the currency have largely been resilient to flare-ups and movement curves this year. The benchmark index is up, around about 11% this year. But that said, the retailers and the tourism industry especially are warning of major impacts from especially the Sydney lockdown. And the warning of the Australian Retailers Association said about $2 billion is set to be lost from that lockdown alone.
Jason, just quickly, we are just getting lines through updating on the state of operational activities at Crown's Perth operations. They've ceased gaming activities from June 27th. Of course, we know that Crown had earlier in the month said that their Perth casino was being investigated for a potential breach of anti-money laundering and counter-terrorism financing rules. They're undergoing similar probes at the company's flagship Melbourne casino as well. So we are seeing that update now that gaming activities will cease from June 27th. Jason, of course, the federal government is coming under increasing criticism, saying lots of people saying we're in this kind of predicament because the vaccine rollout has been so slow. What are we seeing in terms of action on that front?
Yeah, the government, Prime Minister Scott Morrison's federal government has been under a lot of criticism, really, in the last few months, basically saying that the vaccine rollout has been too slow, and also its policy of quarantining returning Australians in hotels, in the city's CBDs has been fundamentally flawed, particularly as this Delta variant enters the country and is spreading more quickly. So, when the pandemic started in March last year, Australia shut its borders, and the health impacts of the pandemic have so far been relatively low. A lot of Australians have thought that's great, but now it's become apparent that there's a slow vaccine rollout, and it's going to go into next year. It's just left Australia vulnerable to the ongoing risk of more breakouts, as more virulent strains spread, and disrupting plans to open the economy could be well into next year before that actually happens. And we've got the problem with both securing and rolling out the vaccines. The government's been accused of being way too slow to get enough vaccines into the population. and the lack of infections itself is, ironically, if you like, has made Australians hesitant around receiving jabs, particularly given concerns around the blood clots from the AstraZeneca vaccine that's been given to people aged over 60. So there's no doubt the flare-ups put more pressure on this government to step up a vaccination program that has really lagged behind other developed nations. There's other nations that have, and regions that have sort of followed that COVID zero model, Singapore, Hong Kong, China, which are facing similar problems.
Jason Scott, our Australian government reporter there, coming to us from Canberra. Let's take another look at how the Australian policy of maintaining COVID zero may be affecting the economic recovery. We're joined now by Moody's Analytics Assistant Director and economist Katrina L. And Katrina, is proven to be just a terrible combination, both the elimination strategy on top of the inability or the slowness in rolling out the vaccines, right? So does this just continue, and how much downside is there for economies like Australia and New Zealand that have gone down this path?
Sure. I mean, what we're seeing in Australia is that, prior to this kind of 2-week lockdown and prior to what was happening in Melbourne, which was the earlier lockdown that just passed, the Australian economy was doing quite well. We were expecting GDP growth this year to come in at around 4.4%, which is incredibly strong and quite a good turnaround from the contraction that was seen last year. But this latest lockdown in Sydney, what's happening in Darwin, the 24-hour lockdown, 48-hour lockdown, and the threat that the Delta strain could meaningfully spread to other states as well, means that there's significant downside risk to our forecast that the Australian economy is going to perform really strongly this year. And one of the key risks that we really foreshadowed going into this lockdown was the fact that the vaccine rollout has been incredibly slow. Something like just less than 5% of Australia's population is fully vaccinated, and that compares with the UK and US, which is sitting at almost 50% of their population fully vaccinated. And it just means that until the vaccine really speeds up, where the Australian economy is going to be really vulnerable to a fit and start recovery mode as we continue to see these localized outbreaks.
Is that a vulnerability that extends to the rest of the world and certainly across the region, particularly as more and more epidemiologists are saying that this is looking more like a seasonal issue that economies and governments will have to contend with?
Definitely. It's not just Australia that has been slow with the vaccine rollout. We know throughout Southeast Asia, even places like Japan as well, Taiwan, Vietnam previously, they've been quite sluggish with their vaccine rollout too. And, those countries that initially were able to contain localized infections quite well, then didn't have that impetus to really be aggressive with vaccine rollouts. And so now that they are seeing these flare-ups in cases, it really is, putting a rocket at, up, the health authorities and saying we really do need to improve the vaccine rollout to really get our economies back on track in a meaningful way and in a sustained way.
And yet we continue to see more signs from emerging markets, from developing nations, that perhaps tightening will happen faster. From the BOK, we saw Mexico raising rates. How concerned are you that this is a bit premature, given that we don't know really the course of vaccinations in many of these countries?
That's a really big concern as well, because for many economies in emerging markets in Asia, particularly Indonesia, we're seeing as a key risk, they're so far just looking at their economy from being in a position where it makes sense for Bank Indonesia, for example, to start tightening rates. But, if we do see the Federal Reserve moving quicker than anticipated and starting to raise the federal funds rate next year or early in 2023, then that really means that Bank Indonesia could be put under pressure to tighten rates more quickly. And that would really be devastating for their economy, because we know that their economic recovery is really lagging the rest of the region because of their elevated local infections. And so they do need to maintain that monetary stimulus for quite some time yet.
Right. The PBOC also has been pretty measured in stimulus measures, right? Is that why we're seeing a little bit of a mixed picture when it comes to eco data? Just shortly, what do you think about their industrial profit growth?
So we're expecting that industrial profit growth in China will remain upbeat, but that's really two factors. It's the result of base effects, because, you know, what happened last year, the industrial profits just spectacularly slumped, but also we're seeing elevated commodity prices is also lifting industrial profits for those larger manufacturers in China.
Katrina L., always great having you with us. Thank you. Moody's Analytics Assistant Director and Economist. Of course, those elevated commodity prices really filtering into those inflation concerns. This as Fed officials debate when they should start raising interest rates. The U.S. jobs report at week's end will also be a key event for investors. Bloomberg Global Economics and Policy Editor Kathleen Hayes is here with the outlook. Kathleen, let's start with the latest official who's turned a bit more hawkish.
Well, certainly less dovish, that's for sure, because Eric Rosengren, president of the Federal Reserve Bank of Boston, has definitely said he could see the first rate hike coming up at the end of next year, 2022. Here's what he said in an interview with Yahoo Finance, if we can call that up. The criteria we have, this is the Fed's goals. We have sustainable inflation rate at 2% above and staying there. Full employment, which he expects, and he thinks it's possible that's going to come by the end of the next year. But it does depend on whether the economy progresses as strongly as I am expecting. Now, another thing he was asked about in this interview was about inflation. He said he thinks there's a lot of continuing hype around inflation. It's a problem now, but it won't be a continuing problem. He does think it's going to ease. Very important, Eric Rosengren for years has talked about financial stability, a lot in relation to banks, but he's calling it out now in terms of the housing market. We've heard other Fed officials mention this as well. We've got a housing boom. Could this get out of control? This is another thing the Fed should be watching. So in other words, he's mixing this in as one more reason for the Fed to start pulling in that stimulus a little sooner. He said this is the wrong time in the cycle to have housing booms that actually could go bust. So Eric Rosengren in the dovish camp, but waiting to make sure the economy is strong, Heidi. And of course, one of the things that's very important now is seeing the labor market, the jobs, the payrolls continuing to grow.
Global Economics and Policy Editor Kathleen Hayes there. Well, in the U.S., Republicans say negotiations for Joe Biden's bipartisan infrastructure plan are back on track. That's after President Biden insisted the $579 billion package was not linked to a larger tax and spending bill, which the GOP opposes. We spoke with White House economic advisor Heather Boshi about what comes now.
We remain very optimistic, very exciting yesterday to see Republicans and Democrats come together on an infrastructure plan that could be a game changer for American industry and for the American economy. You know, we desperately need these investments all across the country in basic infrastructure, roads and bridges. And of course, the plan included making sure that we replace those lead pipes so that people can get clean drinking water, as well as investments in electric vehicle charging stations all across the country.
There is what I think the president calls the human infrastructure part of it. There was talk about that at the White House yesterday, that somehow this is contingent upon that. Give us a sense of what this leaves out, what is left to be done.
The American Jobs Plan and the American Families Plan that the president laid out in the spring include investments in things like home health care, in child care, in establishing a nationwide paid family medical leave program, investments in moving towards universal pre-kindergarten, as well as an expansion, extending the expansion of the child tax credit. So it is really important that those pieces remain a part of the plan because they're so important to American families, and these are also important to American business. And the president made clear yesterday that there is a two-pronged strategy. So this bipartisan bill that has these core pieces that Republicans and Democrats agree are important on, that has one path. But then these other pieces, which around the country, Republicans and Democrats agree are important, but isn't a part of the package. The president is committed to making sure that those go through another congressional vehicle.
Right, that was the White House economic advisor from the U.S. Council of Economic Advisors speaking to Bloomberg's David Weston. Plenty more to come on Daybreak Asia. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
A quick check of the latest business flash headlines. Sources say UBS will permanently allow as many as 2/3 of its employees to adopt a hybrid model of working from home and the office. CEO Ralph Hummers is said to be leading the charge in a bid to be more competitive in recruitment compared with US banks. UBS will also consider working arrangements based on roles and locations. No date for a return to the office has been set yet. HSBC says it's committing $5 billion in lending to help businesses in United Arab Emirates expand globally. The bank says the funds may help firms enter new trade markets or shake up supply chains. The loans will be allocated over the next 2 years and will include green lending discounts. Indian video game streaming platform Loco has received $9 million from investors, including South Korea's Krafton, in its first fundraising effort. Loco was also backed in its seed round by Indian media fund Lumakai and London-based Hero Capital. Loco says it will use the funds to upgrade technology and content. Well, coming up next, oil is riding high on its longest weekly winning streak since December, but an up-in-the-air OPEC Plus meeting this week may spur some risk. Plus, U.S. Energy Secretary Jennifer Granholm tells us that President Biden will fulfill his promise to decarbonize U.S. shale. We have that conversation just ahead. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This is Daybreak Asia. I'm Bonnie Quinn with the first word headlines. Binance says services on its website won't see a direct impact from its ban in the UK. British regulators have issued a consumer warning against Binance Markets, saying it's one of several crypto asset firms which couldn't meet anti-money laundering standards. The exchange says it hadn't yet launched its UK business, which was a separate legal entity, and doesn't offer services on its main website. China's industrial profit growth slowed in May as base effects from last year eased and businesses faced rising costs. Profits at industrial firms rose nearly 37% last month from a year earlier, compared with a 57% increase in April. China says it sees a continuous improvement in the data, though flagged that smaller companies are recovering at a slower pace than larger peers. India has redirected at least 50,000 extra troops to its border with China in a historic shift towards an offensive military posture against its neighbour. Tensions between the two nations escalated last year with several border skirmishes leading to deaths on both sides. Bloomberg has been told that India now has roughly 200,000 troops focused on the border, an increase of more than 40% from last year. Australia has extended virus restrictions as it fights its latest wave of infections. Greater Sydney's 5 million people were put into lockdown on Saturday, while the Northern Territory, Queensland and Western Australia have also imposed new curbs. While case numbers are relatively low, the flare-up puts more pressure on the Morrison government to step up a vaccination program that has lagged many other developed nations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Bonnie Quinn. This is Bloomberg.
Well, oil futures in both London and New York are trading at the highest levels in about 3 years. This as the focus turns to the upcoming July 1st meeting of OPEC. Plus, Bloomberg's Sue Kinnan joins us now for more. So, crude just posting its longest winning streak since December. Is this expected to go ever higher going into that meeting?
Well, there's some expectation that there's a lot of good things that are giving the bulls reason to run. We're seeing oil continue to trade above 74 in Asia trading. That is the highest for West Texas Intermediate since October 2018. We saw it rise 3.4% in the past week, the 5th straight week of gains. So some serious momentum there. Again, OPEC Plus producers do meet later this week on July 1st. And it's a meeting that would pave the way for increased supply, although a modest output increase is expected. The big picture for New York traded oil futures is that they're well above pre-pandemic levels and indeed at multi-year highs. Oil is up more than 50% year to date. This is due to a robust rebound in the key regions such as the U.S. and China. In fact, JPMorgan Chase just increased their projection for oil consumption. Brent crude also at multi-year highs. This is a rapid recovery that's also drained the stockpile buildups we saw during COVID. So as a lot of analysts and traders turn their attention to the OPEC Plus producers, one head of commodity strategy at TD Securities says it's very unlikely, at least from his perspective, that the alliance is going to flood the market with crude, open all the spigots, and collapse the price. We know in the past when prices started to rise, OPEC producers were anxious to do this. They're a bit wizened from the fact that oil did drop below zero briefly during the pandemic, and there's a lot of optimism on the part of oil bills that they will be judicious in the way that they start increasing supply.
And Sue, there was a closely watched Supreme Court ruling late last week that could affect the oil industry. What's the latest?
Yeah, sure. We saw gas futures actually fall Friday on the 6-3 decision from the Supreme Court, which actually found that the EPA, the Environmental Protection Agency, a key regulator here in the U.S., has wide latitude to exempt refineries from these federal rules and mandates that actually require them to mix renewable fuel into gas and diesel. The decision means a big victory for oil companies that have sought to get a break from these rules. They've argued the costs have skyrocketed in recent months. There is a view, however, that the relatively new Biden White House is going to put the pressure on the EPA to force more refineries to comply anyway. So that'll be a battle to stay focused on down the road. Back to you.
Bloomberg Sue Kinnan there in New York. Now, staying on the oil, a sale from Strategic Petroleum Reserves is among the proposed funding sources for President Biden's bipartisan infrastructure bill. But Energy Secretary Jennifer Granholm says any potential sale would be limited. She also told Bloomberg the move would help limit any tax increases.
It's not selling off all of the strategic petroleum reserves. It'll be a limited sale to be able to meet the goal, which is the president's goal was he did not want any of these pay-fors, as you know, to raise taxes on those earning over under 400,000. He didn't want to see a tax on electric vehicles or a gas tax. So this is one of several elements that were used as a paid for. And again, it's a limited sale.
Secretary Granholm, it was interesting that the Republicans put out a document circulated by Republican lawmakers that had the number $6 billion in there, the amount of money that they would raise from the sale of emergency oil reserves. As you say, of course, not the entirety, a portion of them. Is that number wrong?
I'm not saying it's wrong. I'm just saying that that is, this is a framework that was announced. Not everything is set in stone, and it may, it may move a bit. But the bottom line is it is a limited sale.
Secretary Granholm, how far does this deal get toward moving to an electric future? I'm talking about vehicles in particular, given the fact that there isn't necessarily provisions for taxes on gas, higher taxes on gas, and the provision for electric vehicle charging stations is just $7.5 billion versus the call for $174 billion that Biden originally had for electric vehicle initiatives.
Yeah, I mean, part of that 174 was, a big part of it was the point of sale tax, incentives, point of sale incentives for the purchase of electric vehicles so that they are at the same level as internal combustion vehicles. And that's something that the president will still fight for in the second part of the two-step dance that is being done. The first part being the bipartisan part, and the second part being reconciliation, which I'm sure your viewers know is the budget reconciliation process. And in that part, he's going to fight for a lot of the climate-related measures that he put forth in the American Jobs Plan, as well as the measures in the American Families Plan, which involves, preschool. It involves 2 years of free community college. It involves the care economy. So this first step, important, I'll say this, in terms of electrifying the future, is that we have a strong transmission grid. And you saw that there was $74 billion in the power sector, good chunk of that for expanding the capacity, the resiliency of the transmission grid, hugely important for electrifying.
Secretary Granholm, there's a question about the shale producers here. Even as we try to talk about a transition to clean energy, shale producers have been behind a huge surge in economic activity for the United States, a huge concept of U.S. oil independence. And now we've seen shale production fall off substantially during the pandemic and not really come back as much, no longer thought of as the swing producers. How important is it, in your view, to get that production back up and running at the capacity that it has versus the discipline that we're hearing out of the CEOs from a lot of these companies?
Well, I think this is a really important question because the world, as you know, is moving to clean electricity, clean power. And natural gas, an important baseload fuel, has some problems with clean. I mean, it is cleaner than coal, certainly, but it has methane emissions, which is a very potent greenhouse gas. It's got CO2 emissions. What's interesting is in the framework that was announced yesterday, there are a significant amount of money for demonstration projects in what is known as carbon capture and sequestration, which could be used to decarbonize the fossil fuel sector. And that, to me, is another very important technological step and a step that helps our climate goals. And it's technology that can be used here, but also help around the world to decarbonize and everybody get to the goal that all these countries have signed on to, which is at the Paris Agreement, that we get to net zero carbon emissions by 2050. I think that will help. Those kind of technologies will help for this for the oil and gas sector, the gas sector in particular, to be able to ramp up production, but in a way that is clean.
U.S. Energy Secretary Jennifer Granholm there speaking with Bloomberg's Lisa Abramovich. All right, let's take a look at markets setting up for the trading week. Soph, what are you watching?
Well, Heidi, we are drifting early in the session. Nikkei futures a little change. The yen consolidating around 15-month lows. This is policy divergence is widening. So money managers have boosted their shorts for the yen to the biggest level since February 2020. Now, Kiwi and Aussie dollars are under pressure early this Monday with virus curbs being imposed in parts of Australia and New Zealand. And pulling up the chart on the terminal now, a quick snapshot of where we are with Korean markets. That's what I want to show you this Monday. The Kospi hit a fresh record high on Friday. And we do have analysts, the most bullish ever on Korean stocks, with price targets over the next 3 months increasing the most for materials, industrials, energy, and financials, while defensive utilities are the only ones to see some declines as expected by analysts. And terminal users can get deeper insights on this using the FFM, functions for the market function on the terminal. And switching it out once more, using the world currency ranker function to check in on forecast returns for Asian FX. It's the Korean won that is standing out, Sherry, with analysts seeing strength into the year end as markets price in BOK policy normalization. And inflation data due this Friday from South Korea could offer more clarity on just when the stimulus pullback could begin in the country. Sherry.
Yeah, not surprising given the tightening that we've already seen in the likes of Mexico, Czech, and Hungary raising rates last week. Right, coming up next, our exclusive interview with RM CEO and Director Michelle Yeung about the impact of the pandemic on her property, co-working, and fitness businesses, and on diversifying her family's construction empire. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Michelle Yeung is part of the latest generation of the Wohab construction empire. They're the family behind some of Singapore's most iconic landmarks, from Gardens by the Bay to Lau Pa Sat and Jewel at Changi Airport. The Yeung family has been shaping the Lion City's landscape for almost a century. But Michelle's path to joining the family's company wasn't an easy one, in part due to tradition and also fears of the so-called third-generation curse. Michelle currently leads Aurum, a fully owned Wohab subsidiary, which focuses on boutique residential properties. She now also runs a series of businesses focusing on collaboration, from co-working to co-fitness. She spoke to Bloomberg's Juliet Sali about her path and the challenges from the pandemic.
We did take a big hit and had to restructure the business. Possibly the most heartbreaking thing for me during the COVID period was the restructuring of Found 8 and having to let go a lot of team members. But I'm glad to say that it did rebound quite strongly once the government eased the work from home rules. We haven't yet seen a big fall off in membership, but if this continues for a prolonged period, then we expect we will again.
And are you worried that the pandemic has changed people's minds about co-working, co-fitness too? I mean, we're kind of now attuned to being alone or to social distancing. How does that kind of affect your business model?
So actually there are opportunities and upsides for Found 8 for the office co-working business, in that a lot of SMEs or larger businesses that normally would not consider co-working are now interested in co-working because it affords the flexibility for them to upsize or downsize. It gives them opportunity to be able to do split team arrangements, business continuity, best practices that way. So that does balance the downsides. With the fitness and wellness industry, that one rebounded very quickly post-circuit breaker. What we have seen is that because people can't travel in a way that's more disposable income, they're putting a lot more emphasis on self-care. So we've seen a strong increase in demand for fitness and wellness services, in particular the suburban location.
How profitable is this business moving forward?
I think we have moderated our expectations. Initially, when we merged Found and Collisionate to become Foundate, we had huge plans to grow across the region. We are the Google for Startups partner. We anchor the innovation ecosystem, but we don't have physical presence in a lot of the other regional markets. So one of the ambitions was to have regional presence in 5 other markets. COVID put a halt to those plans. So the focus now really is on creating the best value, impact, and growth opportunities and collaboration opportunities for the members within our existing Singapore and KL spaces.
What about further expansion plans?
In terms of regional growth, Co-Collective is the one that we are most focused on because it's a first of its kind co-working for fitness and wellness professionals concept. We've had a lot of interest from all over the world to expand Co-Collective, from Australia, New Zealand, the US. But the next step is actually to go more into the medical space and into the lifestyle, beauty, aesthetics space. We are speaking to a medical center landlord who wants to bring Co-Collective in as sort of a value-added service in the way that a lot of office landlords have brought in co-working operators. Also, I've been approached by a hotel owner to curate the right sort of pick and mix services that really amplify their brand positioning and differentiate them from other hotels. So those are the angles that we are right now exploring.
When it comes to the property business itself, though, we are seeing thinning profit margins. How worrying is that?
Very worrying. And something that we've talked about at length, starting last year, but a lot more this year. And being a boutique property developer, we know we'll never be able to compete against the large developers, nor do we want to. And therefore, our forte, I guess our advantage might be in innovating, which is where the co-retirement idea comes into play. So it's not just residential development in a traditional sense. There are service and programmatic offerings to it. It's a much more targeted segment of the market that I believe is underserved. This is also where Co-Collective with the fitness and wellness services and Foundate with the innovation community could lend richness to the co-retirement concept. So yeah, we are looking to maybe move away from more bread and butter boutique residential developments.
But when you were finishing university, you received a letter from your father, and your brother received a letter too. Now, they both had quite different messages.
In the letter to me, he said that I should spread the risk and find my own sort of vocation and profession, because less than 5% of family firms last past the 3rd generation. And my brother and I being 4th generation, he wanted to sort of diversify the risk. Whereas my brother's letter said that he was earmarked to join the family business and take the helm one day. So yes, there were very different messages, but it was not altogether a surprise.
Perhaps not a surprise, and perhaps the way that traditional families work, but was it upsetting? Did you kind of feel like you had to prove yourself to get your path within the business?
Yes, there was definitely a little bit of disappointment, you know, because I was ahead in terms of academic and timelines graduating. I did wonder whether it was because I was a girl and he was a boy. But actually, I feel very fortunate to have been given the opportunity to explore other careers and been given the choice to join a family business rather than being expected to. And also because I'm not running the core business, I feel I have more flexibility in sort of what direction I would like to take Aurum in.
How important was it to be able to prove to the elders that you had a different vision and to diversify in terms of trying to keep, I guess, the cohesion within the family business?
We were quite aligned already in terms of trying to diversify the entire group and not be so reliant on the construction part of the business. So there was ambition from the board and from myself to try to grow Aurum Land, but I don't think they foresaw that I was going to take it outside of just property development into co-working and into fitness and wellness, and hopefully into the co-retirement space, which is retirement resorts meets co-living, and then into the co-learning space, which is elder care combined with childcare. This evolution of the vision for Aurum Group was not there from the outset, but they are still very supportive because it does, work in line with the overall direction to diversify, and also building on our more mature businesses and the domain knowledge, the infrastructure, the know-how, the expertise to move into peripheral adjacent areas, business models and markets. That's our portfolio strategy. Everyone believes has good merit.
Your eldest son is only 8, your youngest is 1, but would there still be, I guess, kind of hope that they would follow your path?
When my father offered me the opportunity to join the family business and take over Aurum Land, I was not sure what to expect. I said I would give it 2 years, and at that time I had no deep passion for real estate. I just felt like I wanted to change. I wanted to give back to the family that has given me so much. I wanted to create more tangible value than strategy consulting, which was what I had been doing. And I feel very fortunate that the business really suited me. I'm not sure right now what business might suit my children, but if there is a match, then I would love, to see them take over one of the businesses that I have started and really grow it and make it their own.
All right, that was Michelle Young, Aurum Group CEO, Director, speaking to Bloomberg's Juliet Sally. And you can watch, of course, the rest of Generation Next every Monday on Daybreak Asia at 7:40 a.m. Hong Kong time, 7:40 on Sundays if you're watching in New York. We are just getting the Bank of Japan's release of their summary of opinions from their June policy meeting. Of note, we have one BOJ member saying that climate change is related to the bank's mandate, when we do know that the BOJ Governor, Haruhiko Kuroda, has held discussions on the state of the economy as well as climate measures with the Prime Minister Yoshihide Suga in recent days. They have been talking about the extension of the central bank's special COVID measures extended and a new lending measure as well. Of course, this as we see some state of flux for the Japanese economy, the state of emergency as we head into the Tokyo Olympics as well. There's one BOJ member also saying the continued need to support the funding of businesses as these pandemic-related pressures continue to weigh. Lots more to come on Daybreak Asia. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We're counting down to the start of trade in Tokyo and Seoul. Some stories that we're watching today. In Japan, we're watching 7-Eleven after U.S. antitrust regulators ordered it to sell more than 290 gas station retail stores acquired only a few months ago as part of its $21 billion purchase of Marathon Petroleum's Speedway business. Now, Toshiba also in focus after shareholders ousted Chairman Osamu Nagayama and Takashimaya posting a smaller than expected first quarter operating loss. Over in South Korea, Yonhap says a bidding notice for Ssangyong Motor, which is under court-led restructuring, will be made today. The court aims to select a preferred bidder in September after receiving initial bids in late July. Korea Exchange now also saying that Marble Neo submitted an application for preliminary review for an IPO. And POSCO saying it's going to build a steel plant in Hebei province with China's HBIS group. So lots of things to watch. Tell us what you're watching in the markets.
Yeah, Sherry, more stocks to watch here. Crypto exchanges like Japan's Monex Group on watch. They manage online brokerages and crypto exchanges in Japan and abroad. We're also watching Subaru on a Nikkei news report that it's to invest 35 billion yen to boost inspection capacity. And in the Antipodes, watching travel and tourism stocks after Sydney was put under a 2-week lockdown. We're already seeing New Zealand travel names fall after quarantine-free travel to Australia was suspended. We're also keeping an eye on AGL Energy, which local media reports is to announce demerger plans this week. And flipping the word quickly, watching coal producers in Australia after a Chinese official said in an interview with Xinhua that coal prices are set to see a substantial drop next month. Heidi.
Market opens are coming up in Sydney, Seoul and Tokyo next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Hello and welcome to Daybreak Asia. I'm Sherian in New York.
I'm Sophie Kamarudin in Hong Kong.
And I'm Heidi Stroud-Watts in Sydney, taking a look at the major markets opening in Asia. Our top stories this hour. Asian stocks look set for a cautious start to the week as investors assess the pace of the global recovery. Australian shares in focus with Sydney in a 2-week lockdown. Cryptocurrencies are gaining as markets shrug off regulatory concerns. Investors are buoyed by tweets from one of Mexico's richest men. He says his bank is on its way to accepting Bitcoin. And China's industrial profits slow amid rising costs, but early indicators show the economy is rebalancing. Let's get you straight to the market opens in Japan, Korea, and of course here in Australia as well, Soph.
Heidi, we're seeing a tepid start this Monday. We have Japanese stocks gaining some ground. The Nikkei 225 eking out some additional gains after topping 29,000 points on a Friday. While we have the yen trading around a 15-month low, this as we have policy divergence very much in focus. And on that, we got the BOJ meeting minutes for June, in which one member said that any inflationary pressure, that is likely to be temporary. And in the JGB market, we're expecting to see some sluggish moves when it comes to the super long end. This as we have BOJ bond buying on Monday. And switching out the board in South Korea, we have 3.3 trillion won of 30-year bonds up for sale. And we do have the Kospi just stalling somewhat after reaching a record high on a Friday. But we do have the tech-heavy Kosdaq gaining some ground. This is analysts are very bullish when it comes to Korean stocks, with tech the favored sector. And we have the Korean won just a little change as well around that 11.27 handle against the greenback. We're also keeping an eye on IPO scene in South Korea. This after Krafton was told by regulators to revise its prospectus. We're also keeping an eye on crypto exchange stocks. For example, in Japan, we are seeing Monex Group shares fluctuating at the start of cash trade, this with Bitcoin in focus. And in Australia, we are seeing little moves for the ASX 200 at the start of the staggered open, keeping a close eye, of course, on travel and tourism names. This as Sydney enters a 2-week lockdown, during which the RBA is to hold its July policy meeting. Of course, clues around YCC and QE will be very much closely watched. And when it comes to other central banks, RBNZ is expected to pare back its QE buying. That's according to Bank of New Zealand analysts. We are seeing Kiwi stocks a little change, while we're seeing the Kiwi dollar leading G10 losses at the start of trade here. Sherry.
So our next guest now saying that the best opportunities are shifting towards Asia. This is vaccinations positively impact local markets. Joining us from Singapore's Hartmut Issel, head of APAC Equities and Credit at UBS Wealth Management. Hartmut, always great having you with us. Does this mean that you're really firmly on board with the reopening with the reflation trades?
Yes, when we look at Asia, here for Japan, this is one of our overweights. This is certainly a reopening and reflation trade that we highlight in particular, and the market has lagged, and we are seeing that slowly and surely the authorities also become a bit better in the vaccination of the population. The other one I would say, though, China is only partially really reopening and reflation. Remember, about half of the China MSCI index is internet platforms. So here they don't have many friends left right now, as we know, with regulation and investment. But you will see during the second half, I think, the decks getting reshuffled. I think this is an area where there's so much growth and people have neglected it for so long. Tables might turn here.
But what happens once we start to see this policy tightening around the world? We have seen the signals coming from the BOK, not to mention Mexico, Hungary, the Czech Republic raising rates last week. This GTV chart on the Bloomberg showing, yes, global financial conditions are pretty loose, but easing off extreme levels that we've seen in the past.
Yeah, I think that's another reason. That's very interesting that you raised this, right? Because yes, I agree. Many regions either do not become looser or even sort of tighten, especially the US, I guess. Again, China is different. China has already tightened, and arguably that's also part of the reason, other than the internet platforms, why China has lagged other markets. Now, we think in the second half, China is at least neutralizing, possibly even injecting a bit more liquidity on moderate levels, not violent recently. But nonetheless, that's what I mean by tables turning, right? So U.S. tightening, region like China, for example, already tightened and stopped tightening. So also here from a flow point of view, you could see an advantage for China.
What are the green tech industries? You talk about the theme as being a future of Earth. Where are the opportunities there for that theme?
Yeah, and we have a couple, and especially when you mention green, I believe that it's important. Right? Of course, everybody looks at the electric vehicle space, possibly the battery space, and yes, that is of course an interesting, from a growth angle, an interesting area in its own right. But we'd like to take it a little bit broader. I mean, there's a lot of competition in both these areas, and some other areas that are not so often looked at, like storage, like distribution of power. It's very different now from what it used to be. The utilities model completely getting turned on its head. Some of these companies, especially also in solar and wind, are much more profitable, right? So from an economics point of view, it's good to wrap these all into this green basket.
What do you like in terms of alternative yield strategies?
Yeah, I think that right now, certainly the private equity side, with the what it usually offers, the premiums, so the illiquidity premiums is or remains actually very, very interesting. We also see opportunistically a couple of good opportunities coming up. Otherwise, yeah, on the hedge fund side, you can also look at that. We think, especially what you mentioned before, so the Fed basically turning the ship and then eventually tightening, that may also through the summer months give us a bit of volatility that when you let some hedge fund managers help here during this volatility in the next couple of months, that might also be a suitable idea.
Of course, we have the Japan Open right now. We're seeing a little bit of upside at the moment, but given its cyclical nature when it comes to the Japanese stock markets, not to mention some of those green technologies present in that market, what are you seeing as opportunities there?
Yeah, and Japan is of course very, very heavy, especially on the EV side, not just with its large companies that also have maybe even some optionality on hydrogen or fuel cells, if you will, which some other global operators or global OEMs have meanwhile sort of abandoned. So they're actually cooperating with these global operators or OEMs. And even though that's a story that's perhaps a couple of years out, that's interesting. And then naturally, Japan also has a lot of companies, interesting companies in the food chain. So what I mean by that is the components that you need to put into an EV. So they have both, they have the OEMs and the component makers. And that's a fairly big chunk of the market. So also from that angle, beyond the reopening, that's an interesting angle.
Hartmut, always great to have you with us. Hartmut Issel, Head of APAC Equities and Credit for UBS Wealth Management. All right, let's take a look at how some of these tourism, travel, mobility-related stocks are trading here in Australia, given, Soph, this 2-week lockdown.
Yeah, we're seeing moves to the downside with Sydney entering that lockdown. We have some virus curves also being imposed in places like Perth and Peel, although they are not entering a full lockdown. But again, we are seeing those tremors ripple through these tourism and travel-related stocks. Qantas Airways falling more than 3%, Heidi.
Yeah, we're going to get more on that in just a bit. But also, let's take a look at Bitcoin in focus again after its latest regulatory hit. The UK banning crypto exchange Binance from operating there, although the company says it hasn't launched its UK business and services on its website. Therefore, it won't see a direct impact. Let's bring in our cross-assets team editor, Joanna Ossinger. So this is really just the latest that we've seen in the drumbeat of the crypto crackdown.
It is, and actually, Bitcoin is reacting pretty well. It's trading up at almost 35,000 this morning. So clearly, somebody's happy with a look at, say, regulatory stuff, and there's also the chance that Ricardo Salinas is going to have his bank accept Bitcoin at some point. So there are some things going on here that seem like they might be somewhat bullish, and of course, the start to the week can also bring in some of the institutions that were off over the weekend.
And yet we continue to see this push toward regulation. What does that really mean for the operation of the crypto industry?
Well, short term, it definitely creates uncertainty because you don't know exactly what's going to be allowed or not. But in the long term, it could help institutions and even individual investors feel better about the crypto space if they feel like there's some sort of protection for them. So it could be good overall long term.
In the meantime, we continue to see that crackdown in China, right? This is what the MicroStrategy chairman and CEO had to say about that. Take a listen, Joanna.
We think the primary dynamic is the China exodus. There's a forced and there's a rushed exodus of capital and mining from China that was a bit of a surprise that kicked off in May. And that's driving the dynamic in the market right now.
When it comes to Bitcoin pricing, how much of all of that is in the price?
There is some in the price, and of course, Michael Saylor, who was saying that, is quite bullish on Bitcoin. But there's good and bad about it getting out of China. There might be other places that have greener energy that where the mining rigs will go to. But at the same time, there was a lot of, say, hydropower used in some of the regions where the miners are shutting down. So in terms of, say, the environmental aspect of Bitcoin, it looks like it's a little bit uncertain now as to whether it will be good or bad.
Our Cross Assets team editor, Joanna Ossinger, with a wild ride for those crypto assets. And we go to the wild ride in the infrastructure deal here in the U.S. as well. Bonnie Quinn with the first word headlines. Bonnie.
Track now, this after he clarified comments that threatened to derail the bipartisan agreement. Republican senators who signed on to the deal were alarmed that Biden seemed to be making a veto threat by linking the $579 million infrastructure plan to a larger tax and spending bill. However, they say negotiations can move ahead now that he's clarified these remarks.
It was a surprise, to say the least, that those two got linked. And I'm glad they've now been delinked, and it's very clear that we can move forward with a bipartisan bill that's broadly popular, not just among members of Congress, but the American people.
Boeing's updated version of the long-haul 777 jetliner is facing new safety concerns, with U.S. aviation regulators requiring more testing before certification. The FAA is demanding Boeing address multiple shortfalls, including flight control software that apparently triggered the plane to move without pilot input during a flight. The FAA says it doesn't expect certification until mid to late 2023. India has redirected at least 50,000 extra troops to its border with China in a historic shift towards an offensive military posture against its neighbor. Tensions between the two nations escalated last year with several border skirmishes leading to deaths on both sides. Bloomberg has now been told that India now has roughly 200,000 troops focused on the border. That's an increase of more than 40% from last year. UK Prime Minister Boris Johnson has moved to re-establish his government's authority after the Health Secretary resigned for breaking his own pandemic rules. Matt Hancock quit late Saturday after he was caught embracing a senior aide in his office in breach of the social distancing guidelines he had helped to create. Boris Johnson had initially fought to keep Hancock in his job.
I understand the enormous sacrifices that everybody in this country has made, that you have made, and those of us who make these rules have got to stick by them, and that's why I've got to resign. I want to thank people for their incredible sacrifices and what they've done.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Bonnie Quinn. This is Bloomberg.
Well, coming up on Daybreak Asia, Tesla's aspirations in China dealt a blow after the government orders safety fixes for almost all of the the cars, I should say, sold in that country. We have the details later this hour. But just ahead, the only foreign scientist to do research at the Wuhan Institute of Virology is speaking out about her time at the lab and the possibility that it could be the source of COVID-19. That's next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may
be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Well, millions of Australians are now under fresh virus curbs. So new restrictions spanning the country, including a 2-week lockdown in Greater Sydney and a snap 48-hour shutdown in Darwin. Officials are warning that the case count could rise further in New South Wales, where 30 infections were reported over the weekend.
I also do want to foreshadow that given how contagious this strain of the virus is, we do anticipate that in the next few days, case numbers are likely to increase even beyond what we've seen.
Let's bring our Deputy Sydney Bureau Chief, James Thornhill, for more. So, Jim, we will get more of an update, obviously, in about 45 minutes in terms of the new case numbers. But as we stand, it is a 2-week shutdown that we're already in.
Yeah, good morning. That's right, Heidi. Sydney side is facing the first working day of lockdown today, and I think it's fair to say this is the biggest crisis in the pandemic since the Melbourne lockdown last year, where cases got up towards the 1,000 mark. As Gladys Berejiklian, the Premier, mentioned in that snap you just had, we are expecting an increase in the numbers today, probably for the next few days, with this cluster that's developed in Bondi. New South Wales loves to boast that it's got best-in-class contact tracers, and they've certainly been doing a good job so far. Most of the cases they found have been linked to that Bondi cluster, but it's becoming an increasingly difficult job for them as the caseload mounts. So it will be the next few days will be crucial to see if they can really keep a lid on this.
Any idea at this point what the economic and social impact will be?
Yeah, we're starting to get some early figures in, estimates of around 2 billion economic impact just for the 2-week lockdown in Sydney. But as you mentioned, the lockdowns are now broader than just Sydney. Northern Territory is locked down for the next 48 hours, potentially longer, given the severity of that outbreak there. Also, restrictions to a lesser extent in Queensland and Western Australia. So clearly, the economic impact is going to be significant. Probably too early to put an exact number on it, but like I say, 2 billion just for that lockdown. So it could rise to more than that, I would say.
Our Deputy Sydney Bureau Chief is James Thornhill. And Sherry, you tend to link the performance, the handling of the virus situation to political approval, right, for the ruling parties. It's really quite interesting that despite this going on, despite also a lot of the kind of controversy over Scott Morrison's G7 attendance, of course, his activities in the UK, which didn't play out very well when it comes to, the borders still being closed, but him being in the UK, going on some of these side trips as well. Despite all of that, we're actually seeing the latest opinion poll when it comes to the one that the Australian has published, seeing that the coalition's primary vote level actually stay unchanged at about 41%. The Prime Minister's approval rating, though, was increasing by 3 percentage points. So it does seem like, despite everything that's going on and heavy criticism of how slow the vaccine rollout has been, he is, for now, managing to maintain that support as we start to eye potentially when that next election is going to be held.
That is quite an interesting take, isn't it? Because we have seen a lot of criticism over in Japan as well about the slow vaccination rollout there too. But now that they're having faster vaccinations, a Nikkei poll showing that approval ratings for the government have increased. In fact, the dissatisfaction rate with Prime Minister Yoshihide Suga has really gone down. Still, though, many people not happy with hosting the Olympics, and 37% of the population of those surveyed also say that they should be either postponed or canceled. So still more Japanese show willingness to get vaccinated if those vaccines, of course, become available. So yeah, really interesting to see this dynamic between vaccinations, the handling of the pandemic, and what it does for those individual governments, right? And we do have a Bloomberg scoop, Heidi, when it comes to the latest on the pandemic. Virologist Daniel Anderson was the last and only foreign scientist at the Wuhan Institute of Virology, a place that's become a flashpoint in the search for the origin of the worst pandemic in a century. She spoke to Bloomberg about her time there, saying there's no indication it was responsible for the COVID-19 outbreak in any way.
There was no chatter of anything. Scientists are gossipy and excited. So, yeah, nothing strange from my point of view going on at that point that would make you think, oh, something's going on here.
Let's get more from healthcare reporter Michelle Cortez, who wrote that scoop story. Michelle, so give us the highlights of that conversation that you had.
So Danielle Anderson is saying that what she saw on the ground in Wuhan doesn't at all reflect some of the things that she's been reading about in the media in terms of some of the gain of function research that was allegedly being done there, people in the lab having fallen sick with respiratory type illnesses, some inappropriate and not safe use of the technology. She says that's not at all what her experience was. She had to go through 45 hours worth of training, very stepwise in terms of being able to work with any viruses. She worked with Ebola and Nipah when she was at the Wuhan Institute of Virology, and she didn't know anyone who fell sick while she was there. So what she is saying is that it is theoretically possible, because we do know that viruses have escaped from some of these very high containment labs in the past. But the idea that it was man-made in that lab is something that she discounts entirely. And she says that the chances of it actually having come out even accidentally from the lab is very unlikely. She believes, as many other scientists do, that it was something that came from natural origins. But she does say that she thinks that we need to have a full investigation so that we can get to the bottom of it.
Michelle, it feels like 18 months into this pandemic, we're none the wiser as to what is the more compelling argument, right? It seems to be a lot of back and forth over, the wet markets theory, the lab theory, something else entirely. Where does the bulk of academia sit on this?
I think that most academics are saying at this point that it does seem like it would be most likely to have come from natural origins. We do see it all the time. I mean, dozens of viruses do jump from animals into humans over the course of years, and that is a known process that occurs. Now, of course, obviously, they don't normally cause these huge pandemics, the likes of which we haven't seen in almost 100 years. But the fact is that this does happen when we have things going from an animal to a human. The problem is that the Chinese government hasn't been open in terms of allowing people to come in to get to the bottom of it. And the concern is that we really do need to know what caused it so we can make sure that we get a control on making sure that this particular virus doesn't continue to circulate, and so that we can take action so that the next one doesn't come. And that's the concern with the scientists and the researchers. They really want to know what the answer is here. And it did take over a decade for us to identify that was responsible for the original SARS virus. So it could take a while. The concern is that we don't know that we're for sure on the right path to be getting the answers that we really do need.
Michelle Cortez, our Bloomberg Healthcare reporter there with that story. And be sure to tune into Bloomberg Radio to hear more from the day's big news makers. You can get in-depth analysis from the Daybreak team there. They're broadcasting live from our studio in Hong Kong. You can listen in via the app, that's Radio Plus or BloombergRadio.com. We do have lots more ahead. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's a very rainy and stormy day over in Hong Kong. In fact, now Hong Kong is issuing a black rainstorm warning signal, and Hong Kong Exchange now will be canceling the pre-opening if this black rainstorm signal is not lifted by 9 a.m. So we're watching this closely as we continue to see that black rainstorm warning signal over in Hong Kong. In the meantime, here's a quick check of the latest business flash headlines. Sources now saying that UBS will permanently allow as many as 2/3 of its employees to adopt a hybrid model of working from home and the office. CEO Ralph Hammers is said to be leading the charge in a bid to be more competitive in recruitment compared with U.S. banks. UBS will also consider working arrangements based on roles and locations. No date for return to the office has been set. HSBC says it's committing $5 billion in lending to help businesses in the United Arab Emirates expand globally. The bank says the funds may help firms enter new trade markets or shake up supply chains. The loans will be allocated over the next 2 years. Singapore-listed developer CapitaLand will divest partial stakes in 6 of its Raffles City developments in China. The company will be selling the stakes to Ping An Life Insurance, and it expects net proceeds of almost $1.5 billion. The deal should be completed in the 3rd quarter. Still ahead, more Chinese investors being lured to small-cap growth shares in the hunt for big returns. We'll discuss. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
All right, we are seeing, as expected, Australian tourism, travel, airline-related stocks taking a tumble this morning as we get that market reaction of Sydney putting into that 2-week lockdown to battle the outbreak of that highly contagious Delta strain of COVID-19. Other lockdowns around.
And your S&P advancing just a little bit at 42.75, a lift of a little more than 1/10%. Yields coming in 2 basis points to 150.54 on a 10-year Treasury after a really big wide range on a 10-year through last week. And euro-dollar, Tom, just briefly, 119.15. Some weaker euro in the mix this morning. Euro-dollar down to 119.15 and off by about 0.2%.
Yeah, I think, John, you're right, but I'm thunderstruck by a 150, 10-year. We'll see where that heads. This will be fun. Mario Gabelli with us right now, needs no introduction, with Gabelli Funds, and also, of course, his wonderful individual stock work. You sometimes see it in Barron's. We're thrilled that Mr. Gabelli could join us this morning. Mario, I'm going to stay on a stock theme, and I'm going to start out with your wheelhouse. Long ago and far away, you knew where Sparkplug went. You knew the carburetors. You know the automobiles and the tractors. Case Holland is a bet on the American agriculture. You go long Case Holland. Why?
Well, I've got let's assume the stock market's flat for the next 2 years. Assume that the 10-year bond is 2.5. Assume corporate taxes are 25%. How do you make 50%? So I look for companies that can benefit from infrastructure. Case New Holland, even if there isn't any, the construction business will boom in part because of the tailwind of capex from corporations. Secondly, the agricultural ecosystem, farmers have underspent. But more importantly than that, Tom, more importantly, they want precision farming. That's the name of the game. Less water, more precise, less labor because your factories do it autonomously. And then what you want to own is a company that basically also has an ability to do ESG. A new CEO, Scott Wine, came over from Polaris. And so Case New Holland at $15.50 with $1.25 in earnings in 2 years and a spinoff of their Iveco business, which is financial engineering. That's enough reasons to own it and buy it.
Well, let's continue the theme here. Hyster Yale. Most of our viewers and listeners don't know Hyster, Hyster. Hyster Yale. That's not Amazon. What's the risk here of missing out on Amazon and Apple if I go into a Gabelli, Case Holland, or Hyster Yale?
Well, the notion is that you basically have choice in life and choice in making 50%. Another one of my 50%ers, Tom, is a company called Grupo Televisa. But going back to Hyster Yale, the stock's 73, there's 16 million shares. Rankin, who's a young guy at 79, same age as Biden, he basically is running the company, and they've put too much money without demonstrating the success in creating a hydrogen fuel for their forklift trucks, and then taking that skill set and moving it elsewhere. You know, it's a good bet on the recovery of their business, which benefits from the change in logistics. And the stock 73, we thought they would earn $5 in 2 years. We're still sticking with that. But that's not one of my nifty 50 for the moment. But it's an okay play from here, and we own it. We're nibbling at it again. And we own it, and we haven't sold much. It went from 60 to 100 back to 65 or 70 where it's trading now.
Let me pick up on a bigger theme for you. In The Graduate, the line, and this is from your notes, I just want to say one word to you, plastics. Today you say he would have said batteries. Why, Mario?
Well, that's a great point, John. Let's go back one giant step. What we have to do is love the planet, love the people in our planet, and look at the potential. In that regard, climate change requires renewables. That's wind, solar, transmission, where I have a bunch of companies that I like. Cybersecurity, because there's some crazy organizations around the world that are unfettered, but also battery storage. And then on top of that, you have the EV dynamic, and that is, do you do lithium ion or do you lose solid state, or which of those two will work? How do you get fast charge? How do you get longer distance? How do you recycle it? So the battery is an important element in that ecosystem. We're having our 46 years of an auto conference. This time, last year was featuring 3 years ago autonomous vehicles. Last year was pre-owned cars. And this year it's going to be batteries. So I like that over the next 3 or 4 years. How do we get a major battery breakthrough? And companies like Berkshire Hathaway understand that, what they're doing in their field, and companies that provide lithium like Albemarle and Livent and so on benefit from that. And how do we do it in the U.S.?
Are you more interested in doing it then through the batteries, through the technology that goes into the car, or can you do it through the auto manufacturer? Which one is it, Mario?
The answer is that we look at the entire ecosystem. I'm just picking batteries because it was if you saw The Graduate, which was R-rated probably at the time, there was that scene in there where Dustin Hoffman has to confront the husband, or is confronted by the husband of, and without getting into details, for this is a family program, I think. That's it. So it's batteries is a good soundbite. You could have said removal of plastics, recycling of plastics. Got it. But I chose batteries because I spent my 55 years in the auto industry.
So, Mario, there is a question, if we want to go to the graduate in parallels, where Dustin Hoffman was under the water, blowing bubbles, and sort of trying to reset his life. And there is a question as you try to look for bottom-up opportunities about how you even evaluate what's been priced in, because a lot of the companies that you're talking about, the industries, particularly within renewable energy and batteries, have been incredibly highly bid up because people agree with you. At what point is it too much, and has it been priced in?
You always look at value versus price. I think you'll make a significant 50% in 4 years. I'll give you the 4 names, and then you can pick whatever you want. I gave you Case New Holland. I give you Grupo Television because the Spanish market is doing well. The good management, the financial engineering, they're converting it with Univision, and Univision's going public sometime in the next 6 months. And then you have, in addition to that, a company that's buying at a bargain price, going back to your EV notion, electric vehicles for the last mile, electric vehicles, period, electric trucks. Company and Volkswagen spun off their truck business, Traton, but they have a lot of that intellectual capacity, and they're buying at a bargain price Navistar, which is closing shortly. Traton is selling at 28 euros. They're going to earn $4 plus, and you've got a good play, and the stock is a 50%er in 2 years. So, there's a lot of ways to participate at the margins on some of these stocks, and then obviously you got to play baseball at this time of year. So you don't need to say what's overpriced in this market. What happens when the government comes in with a $6.2 trillion expenditure and raise only $4 trillion, and we got an increased deficit? We think about those things, but we look at companies, Lisa, with a microscope, and then we look and step back with a telescope and say, what's going to work 2 years from now? Some of these stocks we don't chase, and nor did we go short Nicola or and so on.
So I will let you talk about the opportunities in baseball with Tom, and I'm sure that you have things to sell him for his triple leverage cash fund. There is a question, though, about concentration, especially as someone who has been bottom up for so many years. Do you have more confidence in a higher degree of concentration in your portfolio, if you can do the analysis, than you have in the past, just based on where we are in the credit cycle?
Well, you take our small cap fund, okay? We love the ignored and unloved. And so when we go see a company, and now, by the way, finally getting out to see 3 or 4 companies, I saw one that's not in small cap, IT&T. You listen to that story, you listen to how management is executing, you listen to how every day they come in and work, and they work their fannies off for the economy, for the company, for their shareholders, and for their constituents. So there's a lot of companies that are not fully understood because of the new dynamics in the market, Momo, algos, obviously, and so on. And then there's a lot of risks. The risks that you point out, I worry about the high margin requirements. Should we increase the margin requirement? I worry about shadow banking. The Dodd-Frank, today you guys are talking about the huge amount of money coming in by the banks this afternoon or tomorrow. But it's in part they were reined in by Dodd-Frank. Give Dodd-Frank some credits. In addition to that, so we look at the valuations, and we look at what is the present value of the future stream and who's going to buy the company.
Right.
Lisa, think about SPACs, think about strategics buying companies with their stocks at these prices, using it as a currency, and even companies that we like are selling converts with a 1% coupon up 40% to raise money.
Mario, I want to talk about the heart and soul of the matter, particularly going into this earnings season, and this goes back to the wonderful Jack Welch. The idea of pricing power. Revenues are made up of a unit dynamic and a price dynamic. Are we going to have pricing power and unit growth to go with it?
That's a good question, Tom. The way we look at the model is everybody talks 7% GDP growth, but that's real. You got 3% inflation. Revenues are going to grow 10%. So if I was the only company in the United States, I'm going to have 10% revenue increase, and I'm going to basically look for improvement in 2022, in part because of the lag effect of certain companies coming through. But if I have a surge in my cost, which is crimping my gross margin, can I pass through my cost with the margin maintained? There are companies that can do that. SG&A is not going to rise 10%. So I have an increase in pre-tax margin, and then I'm going to get hurt by taxes, and I'm going to be hurt by an increase in the multiple.
But Mario, the heart of the matter here, and this goes back to the religion of Gabelli, is I want my cash back. I want dividend growth. I want share buyback. Do you see any change in use of cash dynamics?
Yeah, I'm not a big fan of cash buyback. And if if you're going to pay 40% on dividends, and you got a SALT tax that adds 13, and then you got the Obama tax on top of that, you're going to keep 30%. And that's a triple tax on shareholders. No, I'm not a big fan of dividends. I like the Buffett approach. Get good managements that compound. Yes, he's buying back stock because it's selling well below intrinsic value. But Tom, a year ago when I was on a program, we had shortages. People were concerned about financial liquidity. Today, they're not as concerned about that. They want supply. They're over-ordering, and you're going to see some of that. And the surge in prices, you saw lumber come down from $1,700 to $800. But you're going to have wage increases because there's a shortage of labor, and that gives you your wage push element to inflation, and that's what we have to be sensitive about. And one of my directors, Karl Atterperl, when he was head of the Bundesbank, said, it's like inflation is like toothpaste. Once it gets out, it's very hard to put it back in the tube. So we have to be super sensitive. At what point does Powell lift his foot off the accelerator on financial dynamics in terms of pumping money into the system? And how will the market react? But that's just a short-term pothole in the next 10-year voyage for stock ownership.
Mario, let's not wait another year before we talk again. It's great to catch up, sir, as always. Mario Gabelli there, Gabelli Fund CEO and Chairman. Pricing power, a big issue there, Tika, and it's a big issue for a lot of people looking at this equity market.
And I know we're going to get through jobs, and we're going to do that on Friday, and we'll figure taper this, taper that. John, the mystery right now is the difference of opinions we see on Bloomberg surveillance on what earnings will be. Yes, June 30 end, you'll see them in 30 days, but really the next quarter on and the next quarter on from that, there is a raging debate, and Gabelli's clearly on the side of that. They're going to be positive.
Margins, Lisa, and they were resilient through Q1. Will that be true at 2, 3, and 4?
Especially as we see certain commodity prices actually come off their highs earlier in the year. Does that actually give a boost to margins beyond what people were expecting, or are higher wages going to eat into it? And I do wonder how much people have accounted for some of these wage increases we've seen, particularly in the restaurant industry.
So everyone's talking about peak everything. Have we seen peak inflation fears? Can we say that yet?
I mean, are you willing to say that? I'm not willing to say that yet. I'm not going to weigh in.
Look at where the price action is. Look at where break-evens are. Can we make that point?
Yes.
Can we make that point based on market perceptions of inflation, price pressure?
What's interesting is that you can see it in the bond market. In stock markets, and certainly among analysts, you do not hear that belief. We do think that there is this sort of percolating inflation fear out there.
It's the gloom, John, of the pendulum.
I don't know if that was too gloomy, but I'm with you.
The pendulum of margins.
Usually, Lisa is gloomy. I'm not sure if that was too gloomy. I think when you do talk to equity investors, they seem to be very, very laser focused on cost and pricing power and where that shows up in a more acute way in which sectors.
I can't give my opinion here. It's not. We're not supposed to give our opinion.
When have you held back from giving back your opinion on anything?
The closest I'm going to come to opinion is a lot of research. The lobster supply is off in Maine this year.
Okay.
It's a little bit ebbed.
This trip, we're not going to hear the end of it, are we?
No.
You're going away again this summer, or is this it?
No, I think it's
4 days in May.
It's it.
We're done.
You've got another 3 weeks vacation coming, so, I got to be here to take care of that.
Oh, TK, you and I are having words. 42.76 on the S&P. Coming up.
Are they going to put us in the same bar for Germany, England?
I don't think you are allowed in the same room. You think they'll let that happen in a pub?
I don't know.
Coming up on the Open, State Street Global Advisor CIO Laurie Heinel. Looking forward to that. From New York City this morning, good morning. On TV, on radio, this is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Inflation is going to be transitory. If we do get wage growth, which I think is coming, I think inflation is going to be a problem. When people have more money and it costs more to produce a few things, it's going to come through in higher prices.
Patrick Armstrong there on the pace of the market as well. Futures up 5, Dow futures negative 16. NASDAQ futures resilient through the morning, even on a little bit of a movement. Of course, Jobs Day on Friday. We'll have all that coverage for you. Lisa Abramowitz and Tom Keene with us right now. We start strong on the 100th anniversary of the Chinese Communist Party. Tom Orlik joins us to say he's Bloomberg Economics chief economist. Doesn't describe his China knowledge, the bubble that never pops. Got rave reviews out on Oxford here in the recent months. Tom Orlik, thank you so much for joining. I just want to go to your book where you talk about the fourth cycle we're in right now. How does President Xi get his Communist Party to the fifth cycle?
Yeah, it's a great question, Tom. And this 100th year anniversary of the Communist Party on July the 1st is going to be primarily, of course, a celebration of success and development in the last 40 years. But looking forward, there's opportunities, huge investment in technology, efforts to boost fertility to offset the demographic drag from the one-child policy. Xi will hope that he can deliver on his objective of doubling the size of the economy again by 2035, but also some huge challenges. The overhang of debt, the slowdown in reform of the state sector, and of course, decoupling from the United States and its allies, which threatens to slow the cross-border flow of ideas, which has been a real driver of China's development.
Tom, if you're on the Bund in Shanghai and you wander back on one of those streets, you move back to the French concession where all the West had their own unique neighborhood. And there in 1921, I've been to the house. It's a museum now of the history of the Communist Party. How attached is that museum and all it represents? How attached is it to the Chinese people?
It's a great question, Tom. And I think when the Communist Party look back on their last 100 years, they're going to be celebrating a lot of successes. They're going to be celebrating their success in kicking the Japanese out in the period around World War II. They're going to be celebrating the success of Deng Xiaoping and his reforms, which have lifted China up to global GDP rankings over the last 40 years. What we're going to hear less about in that history of the last 100 years is some of the missteps. We won't hear much about the Great Leap Forward. We won't hear much about the Cultural Revolution. We won't hear much about events today in Xinjiang. And I think for the rest of the world, this is a kind of a reminder that when a single-party state gets it right, they can deliver enormous benefits. When they get it wrong, there can be some really serious missteps.
Tom, how much does China want to sort of emphasize the communist shift behind this party versus the more democratic and frankly capitalistic shift that you've seen the nation take on?
So I think that here in the West, Lisa, we think that the recipe for success in China is going to be to move closer to the Western model, right? We think a China which is democratic, a China which is more market-oriented, is the only China which is going to succeed in the 21st century. That's not the view of the Chinese Communist Party. That's not the view of Xi Jinping. Especially looking through the lens of the COVID crisis, what they see is that democracies and markets failed, and the Chinese Communist Party succeeded, controlling the virus, getting the economy going again. They think that the events of the COVID year, the events of the last 100 years, demonstrate the success of their governance model. They're going to be doubling down on it, doubling down on their political model and their economic model as they go forwards.
Tom, is the CCP gaining popular support among the rank and file in China or losing it?
So, I mean, that's really an extremely difficult question to answer, Lisa. There's no elections in China. There's a limited role for the press in China. We don't have opinion polls out of China. What I can say, though, is that a party which delivers very, very substantial increases, improvements in the quality of life, the quality of living for a very, very large share of the population, typically enjoys some solid support, and I think that captures the situation in China.
Tell me about the reach of the Communist Party outside China, very quickly here, Tom. How powerful are they in a traditional communist rhetoric?
So I think we have to draw a distinction between the old USSR, which wanted to spread communism, and the modern Chinese Communist Party, which wants to increase Chinese influence, but doesn't really care so much about the ideological component of it. So yes, we've got the Belt and Road spreading Chinese funding and Chinese political influence around the world. But are the countries which take that Belt and Road funding moving towards a kind of a communist ideology? No, not really. They're aligning more with China's global interests. But Beijing doesn't really care whether they move onto a kind of Mao Zedong, Chairman Marx, that's Mao Zedong, Karl Marx type trajectory.
Tom, I'll kind of leave it there. Thank you so much. Wonderful to start our coverage here of what we see July 1st with Mr. Orlick. I can't say enough about his book, which is piercing, got rave reviews. Its immediacy, his journalism in China. Lisa, you know, it's sort of a sideshow to all that's going on here, but it's 100 years on from something that changed the world, whether you agree or not with their themes.
And perhaps this sideshow is very much front and center when it talks to the rebalancing of geopolitical power at a time when the East versus the West is taking on a very different tone, and President Biden is trying to gain some of the alliances back in order to come up with a strategy to counter China. I mean, this to me is very much in the front and center.
And you wonder, after the president's trip to Europe and the perceived success of that, what will it be like when we see a Biden on the Pacific Rim here?
Yeah.
I believe that's scheduled out there as well. Lisa, I thought Brill was brilliant.
He was,
well, I'm sorry.
It is. I have to offer up a surveillance correction, because Canada called and they were put off when I said that it was a less vaccinated region than the rest of the world, because actually they are now leading in the number of percentage of first shots doled out to its citizens, with about 3/4 of the population having received at least one shot versus, but That said, fully vaccinated, not as much as the U.S. and Israel and certain places in the European Union, but it shows, frankly, the insecurity around needing to get a certain proportion of the population vaccinated in order to entice travelers, in order to entice business.
Now, to save yourself further, Canada, Corey Price looks awfully good tonight against Tampa, doesn't he?
Oh, yeah, I'm following that game closely. This is my sports space. I can talk as intelligibly about hockey as you can about football.
The clock can't move fast enough. We start on Monday and we go through the week. Important economic data. Jobs day on Friday. Within that, well, it's a bull market. NASDAQ 100 out to highs for the day. Up fractionally, but nevertheless, there it is. Up. Please stay with us. Adam Posen coming up. This is Bloomberg. Good morning.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated. The world is possible.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our audience worldwide, good morning, good morning. Equity markets coming into Monday morning at all-time highs on the S&P 500 with 30 minutes to go. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, pushing ahead to Payrolls Friday.
You have to look at the jobs market, the labor market. The labor market is not functioning the way you would expect. A lot of slack.
There are more job openings than there are unemployed people.
There's a labor shortage. A lot of opportunities available that people aren't filling. There's more going on.
We have a skills mismatch.
There's about skill mismatches.
We need to see a lot of the job openings be filled.
It's coming down to wages.
That's why you're seeing wages go up.
Economists are really trying to parse the data.
The wage inflation issue is a very important issue.
See, what's going on with wage inflation.
Have to look at wages. There are fundamental things going. Look at.
Joining us now is State Street's Laurie Heinel and Neuberger Berman's Ashok Padia. Guys, great to catch up with you. Let's just start right there, Laurie. Demand's red hot. Will supply finally arrive?
Well, we think that the next several months are going to be pretty precarious because you've got a lot of pent-up demand, you've got a lot of cash in the wallets of consumers, and yet there are likely to be a fair amount of supply shocks as we work our way through the back half of the year. So we think inflationary pressures will continue at least for the next several months.
You can fit a truck through these estimates going into Friday. The high estimate's 1 million, the low is 400K, the median estimate's 700,000. Bottom line, Ashok, we still don't have any clue when the supply side of this economy starts to respond with a little bit more vigor.
Yeah, our view is that the supply is going to be a little slower to come back on. I mean, there's two big issues going on, we think. One is some of the incentives that the extra unemployment checks that are probably keeping some people out of the labor force. But the larger issue is this demographic, age 55 and older, that is not supplying the levels of jobs that they were pre-COVID. And our suspicion is that cohort is going to be much slower to come back. And that's going to make some of these headline payroll numbers a little harder to get the big numbers that some of those top ends of the estimates.
Ashok, why is that the case? What's holding them back?
I think there's a lot of things, and there's a high degree, I think, of speculation still, but that is a cohort that's naturally aging, that they may be pushing up retirement, that they would have retired a few years, from now. Part of it may be equity and stock and wealth gains. Part of it may be reassessment of, life objectives, and part of it may be moving to lower cost areas of the country with work from home types of opportunities. So there's a lot to disentangle. I think that's going to be one of the big stories we're sorting out over the next, 12 months. But to the extent that those couple million plus jobs aren't coming back, it is, we think, going to feed a bit more wage pressure, and it's going to keep payroll growth slower, and ultimately, we think, keep the Fed slower to be unwinding these policies.
Well, you've picked up on the theme, how long it will take to work out some of these ideas. And Laurie Heinel, right now, job openings in America north of 9 million. Do you think that's a number that lingers, something that can persist through summer?
Well, we actually think that the employment picture will continue to improve. But the other thing to keep in mind is that we need productivity enhancements too and technology investment. And so there are early signs that we're starting to see a little bit more capital investment. And in the service economy in particular, which has really lagged manufacturing in terms of industrialization, in terms of technology, in terms of productivity enhancements, that's a place to watch as well. So while we do think that the labor picture will improve more slowly than ideal, we also think that you've got to keep an eye on some of those productivity enhancements and ultimately capital investments.
And what all this means for the Federal Reserve. Boston Fed President Eric Rosengren seeing a possible rate hike as early as 22. He spoke to Yahoo News. The following quote: "The criteria is that we have a sustainable inflation rate that's 2% or above, and they're at full employment. I expect it's quite possible we'll see that by the end of next year." This coming ahead of another big week for Fed speak. Let's bring in our Bloomberg International Economics and Policy correspondent, Mike McKee. Morning, Mike.
Morning, John. We're watching for some headlines from John Williams from the New York Fed. He's speaking at this hour, and we'll be watching Fed officials all week. But let me pick up on something that Laurie mentioned. Several more months of high inflation. This is important. You take a look at the chart, and of course, everybody freaked out last week when we got that 3.9% PCE inflation rate, the highest since 2008. Everyone except the stock, bond, and currency markets. Why are the markets so sanguine at this point? Well, take a look at the red line there. That's the inflation average, 1.6% since the beginning of the pandemic. It's 18 months of still below 2%, and that's what the Fed is shooting for, that 2% number. So it's going to take several more months just to get there. Then the question is, how long do they leave it above that? Well, we've got a week of economic data that will give us some clues. You start with the ISM in particular, prices paid. Now, we know there's been a supply-side problem there, and that's pushing up prices. And then, of course, we push ahead onto Friday, and Friday's the big jobs number. As John mentioned, 700,000 is the consensus forecast, with a drop to 3.7% for unemployment. If we get that, where are we? Well, again, we're still a long ways from the Fed's target. Take a look at the employment numbers situation. In this chart, you can see that where we are is still high above where the Fed wants to be. The numbers up top in the line there, that's what the Fed saw before the pandemic, and they want to get back to those numbers before they start talking about tapering or raising rates. Now, they might taper before they completely get there, but it's going to be a couple more months of watching the employment numbers to see if they're ready to do that.
Mike, have we nailed down who the 22 dots are in the dot plot in the summary of economic projections? I count Rosengren, Bostic. Who else have we got? Kaplan, Bullard. There's 4.
Well, we'll be talking with Rob Kaplan later this week, and definitely there are 4, but it's a question of 7. So how many of the others? You can figure maybe Esther George is in there, possibly Loretta Mester, although she's been relatively dovish. So people will be watching the Fed speak, but you're really not going to get a clear picture until we get closer to the end of the year.
Mike McKee, thank you. Good to have you back ahead of Payrolls Friday. Laurie Heindel, I want to turn to you. The data is one part of the story. How the market responds to the data is the other. Just how sensitive do you think this market is to incoming data through the next several weeks?
Well, it's actually been very complacent, shockingly so. So we think that surprises are a possibility, and that will actually pretty much destabilize the market, particularly if it looks like there's anything where, again, the Fed is not being consistent in the way it's messaging. And that's where I think where the Fed governors are not aligned, and their ability to move markets when they make comments that seem a little bit off base relative to what Powell is saying, that's been something that the markets have really been skittish about.
Ashok, build on that. Is good news bad news? And how bad would a good print be for this Treasury market this Friday?
Yeah, I very much agree with the point that I think the next 6 months data sensitivity is going up. And because the pace of employment and jobs numbers is going to impact the start size of tapering and ultimately whether it's a 2022-23 hike. So weak employment numbers, I think you're going to see the 22 hikes or 23 hikes start to get pushed back. You'll see some steepening of the curve. And likewise, the inflation data. I mean, the Fed meeting had a lot of cross currents, but I think one general important theme is the Fed's less comfortable with taking what we would call right tail inflation risk, or a big move and a persistent move to these higher inflation rates. So if we start to see continued increase in CPI prints, I think that's also going to start to bring in a larger reaction than we've seen over the last 6 months.
Ashok, if you can clarify something for me, it'd be really helpful. Do you think tapering leads to higher yields or lower yields? Now, I know on the surface of things that might be obvious, but actually, given how things have played out recently, I don't think anything is obvious. What are you anticipating?
I think of the Fed, we think of the Fed's going to move down from its $120 billion of purchases, focus it on mortgages, maybe start in the fall. Don't think it's going to have a big driver of rates. I think it's going to be, this is, I think, not going to be a similar story than some of the previous tapering where it actually drove a lower yield environment. I think the amount of Fed purchasing is so significant in this market compared to the economic outcomes that the economic outcomes are really going to dominate. So don't think it's a tradable theme for the direction of rates.
Laurie Heindel, do you agree with that?
Well, I think you have to wonder what's the backdrop, right? If the economic momentum continues, and we see actually accelerating economic momentum into 2022. So a Fed tapering against that kind of backdrop would actually foreshadow higher rates because you'd have, basically higher economic growth. So we actually think the most likely scenario is that we do continue to have momentum in the economy. That does eventually lead to Fed tapering, and that's actually a good thing.
Laurie, you just said accelerate. You think things can accelerate from 21 into 22?
We absolutely do. And part of that is because you're going to see other geographies come more fully online. So Europe, for example, has been quite slow to ramp up because they've had a lot more challenges with the pandemic. Certainly the emerging world is still getting the pandemic behind them. So while the U.S. may start to wane a little bit relative to 2021, we actually think other parts of the globe are going to pick up pretty substantially. So we would think 2022 will be the sweet spot for global growth.
Laurie, are you actively positioning for that right now?
We are. We actually are still overweight equities, although we've pared that back a little bit from just a couple of months ago. And we've been fading into Europe and more importantly into emerging markets as well. So we've been trying to sort of follow the trajectory of this growth as we see it evolving.
Ashok, what do you make of that regional bias from the fixed income perspective?
Yeah, I think it's going to be hard for U.S. and Chinese growth to be higher in 2022, just looking at GDP prints, than next year. But do think you can see a bit of acceleration, and we'll see some acceleration in some of the emerging markets, particularly as, you know, there's just sort of a phased reopening of the global economy. So that idea of transitioning above trend growth rates, I think, is reasonable. I'd be surprised if global growth in 22 and 23 is higher than the nominal levels. But from an investment conclusion, these are still very likely to be above trend years for, you know, the U.S., Europe, China, lots of parts of Asia. And that is, you know, even if it is a bit of a deceleration, these are still going to be pretty strong growth numbers.
Ashok Pandya, Laurie Heinel sticking with me. Equity futures up by a little more than 1/10% on the S&P, 42.77. Let's get you some moves at the market desk. Here's Taylor.
John, let's start with some of the travel stocks. We're taking a look at shares of Boeing pre-market, of course, getting hit by some new safety concerns around the 777. The FAA now may not certify that until 2023. United's buying some new jets, but of course not enough to offset some of the market declines that we see. Tesla's rebounding despite some earlier losses. You're getting more China software recalls, about 300,000 cars, 90% of local output, due to some of the cruise control system issues. And Carnival Cruise Lines, some tepid outlook last week. They're now not seeing the entire fleet sailing by spring. That is later than they hoped. Let's change the board and look at some of the gene editing technology and some of the pharmaceutical space. Regeneron Pharmaceuticals and Intelliat Therapeutics, they're reporting some positive interim data from a phase 1 clinical study, all to treat liver disease. They're using that new CRISPR technology, so you're seeing some other competitors jump on that news as well. Finally, it's Monday. Let's get an update on how Bitcoin trades over the weekend, because it does not close. We didn't break below 30,000. We tried to trade closer to 35,000 this morning. AMC also, they're getting a fundamental boost. That latest Fast and Furious movie, John, it races out of the gate. See what I did there? It shatters pandemic
wonderful.
records.
That was a great play on words.
Fundamentals.
Taylor, thank you. Taylor Briggs, thank you very much. With us through the hour. Coming up, President Biden hitting the road to promote his infrastructure plan after regaining key Republican support. That conversation coming up down in D.C. next. From New York City this morning, good morning. Counting it down to the opening bell, about 18 minutes away. We're up 6. We advance 0.15% from a steamy New York City. Your S&P 4277. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I do trust the president, and he made very clear in the much larger statement that came out over the weekend, carefully crafted and thought through piece by piece, that if the infrastructure bill reaches his desk and it comes alone, he will sign it.
I was very glad to see the president clarify his remarks, and it's very clear that we can move forward with a bipartisan bill that's broadly popular, not just among members of Congress, but the American people.
President Biden regaining key Republican support after clarifying comments that threatened to derail the infrastructure deal. The president writing in a statement, quote, "To be clear, our bipartisan agreement does not preclude Republicans from attempting to defeat my family's plan. Likewise, they should have no objections to my devoted efforts to pass the family's plan and other proposals in tandem. We will let the American people and the Congress decide." Let's head down to D.C. for more with Bloomberg's Anne-Marie Hordern in Washington. Anne-Marie, let's start here. Have we settled this one after those comments, that statement over the weekend?
Good morning, John. I think the key really in that statement was the fact that the president also said, my comments created this impression that I would be vetoing this bipartisan deal if it was to hit my desk, and that is not what I had meant. So if you look at the sound from the Sunday shows and you heard Senator Portman, Senator Romney, Senator Cassidy talking about this, they do think that they can still work with the president, the bipartisan, that infrastructure deal, hard infrastructure we're talking about. They still think that there is a way and a path for that to get through. The question, though, John, is about the president's own party. Speaker Nancy Pelosi really put a red line in the sand, as far as I can tell, when she said that her chamber will not even bring forward this bipartisan deal to vote on and discuss until the Senate also passes through reconciliation some of that broader human infrastructure, part of the family's plan about child care, Medicare, and that would also mean higher taxes. So I think it's that nod to the progressives that President Biden was trying to give, that he had to backtrack on, but that's potentially where there's going to be a bit of a problem.
Anne-Marie, I know the president starts a domestic tour in the next 24 hours. He begins that tour in Wisconsin. What's the objective?
Yeah, Josh Wingrove will be all over that tour. It starts tomorrow in Wisconsin. And really objective, John, is just to drum up support for this deal across the country. One, the bipartisan infrastructure deal, the hard deal. But I think it's really also for the president to make his case and the Democrats' case for infrastructure more broadly. Things like climate change, things like child care and Medicare, and why the president and the Democrats are really focused on potentially raising taxes, corporate taxes on the richest in this country to bring about those changes. So it's really just a drum up support. They have, I have to say, a few weeks and then months to get this done, because then D.C. will really be looking forward to the midterm elections.
Anne-Marie, my good friend Anne-Marie Hordern down in Washington, D.C. It's good to see you. Thank you. How about he's James Afty, warning that infrastructure talks might do more harm than good, adding to a growing chorus of investors seeing peak growth in the U.S. Take a listen.
We've probably seen the best of it for U.S. growth, and we've probably seen the best of it for U.S. growth expectations. And I think fiscal policy, you know, we're still talking about infrastructure packages, but the magnitude is just minuscule relative to what's in the rearview mirror. So from an impulse perspective, I think fiscal policy will increasingly be a headwind.
Fiscal policy will increasingly be a headwind. Let's head back to State Street's Laurie Heinel and Ashok Bhatia of Neuberger Berman. I want to start there, Laurie. You pushed back a little bit earlier against this deceleration theme going into 22. What do you make of this peak everything theme that also includes peak fiscal policy?
Well, we don't think we're at peak fiscal policy, and the fact that we're talking about a near $1 trillion deal certainly suggests that there's more room to run. But let's not forget that we've had a lot of spending over the last couple of years, and so there is a kind of a constraint. And if anything, we think that the infrastructure bill may not be as ambitious as what's ultimately needed to repair a lot of the infrastructure in the country.
Ashok, what are your thoughts on this?
Yeah, I think the peak growth, I think we're trying to rephrase it or think about it maybe a little differently, which is the key impulse is that this is going to be, we think, an elongation of above trend growth. And it's certainly true that, GDP next year is probably lower, and that might lead one to think that one needs to get more defensive in a lot of positionings later in this year. But this transition from above trend growth to something else, or from very high growth, is going to be a transition from very high growth to still high growth and above trend growth. And that's going to be different than what we've really experienced in a lot of the years since the financial crisis. And, you know, in our minds, makes the growth, credit markets, rates markets, a lot of these trends can continue even if growth is peaking right now.
Well, let's narrow in on the credit market specifically. Ashok, I mentioned this on Friday. I did again this morning. I'll do again now. Centene sold $1.8 billion of junk bonds last week. My colleague, reporter, friend, Alex Wittenberg, writes up that the yield was 2.45%, 2.45 on high-yield debt, Ashok. Spreads are already the tightest since 2007. At this point of the cycle. And I just wonder, from your perspective, how do you think about credit now? Do you have to change the way you think about the universe, the asset class, given where we're already priced?
I think for the next 12 to 18 months, we think credit spreads are going to remain at historically very tight levels. I mean, just take the high yield market. Not inconceivable default rates are going to be less than 1%. Not inconceivable we're going to see more high yield issuers upgraded to investment grade than downgraded from investment grade down to high yield. This trend, this above trend high growth rate that persists, is fundamentally a really powerful driver for credit. And importantly, we're not seeing management teams generally wanting to leverage up. If anything, some of the bigger transactions that have been done have been deleveraging transactions. So that fundamental story is going, we think, to keep valuations very tight. Now, if we do transition to something where growth remains high, but companies start to respond to, some deceleration impulse by doing some leveraging transactions and things like that, that could become a negative for the credit market. But overall, tight spreads, we think, are going to be with us for a while.
Laurie, do you agree?
We do. We've actually been overweight credit against that very backdrop. The fact that you've got improving fundamentals, even though you have tight spreads, the search for yield goes on. There's a lot of good demand. Technicals in the market continue to be pretty attractive. So we actually do think that spreads could stay pretty tight here for, at least the next several months or so.
Laurie Heinel from State Street, Ashok Bhatia of Neuberger Berman. Guys, really good to catch up this Monday morning. Thank you. Coming up, your morning calls, and later, investors debating the outlook for the reflation trade amid rising concerns about new COVID strains. That conversation still ahead with Nuveen's Brian Nick and Stuart Kaiser of UBS as we count you down to the opening bell, 8 minutes away. Equities coming into Monday at record highs following the biggest weekly gains since February on the S&P 500. 42.79 is where the S&P is at the moment, up around about 8 points and advancing 0.19%. From a hot New York City, this is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
more than 5 minutes away from the opening bell in New York City this morning. Good morning to you. Coming off the back of the biggest weekly gain on the S&P 500, going back to February, futures advanced 7 points on the S&P, up by almost 0.2%. Within that move last week, it was also the banks that participated in a big way. The biggest weekly gain for that sector going back to February as well, following the biggest weekly sell-off in treasuries going back to March. Yields higher, 8 or 9 basis points. That helped give the banks a little lift. After the close today, June 28th, today, after the close, we hear from the banks, and we could get an avalanche of payouts that could total, for the 6 biggest US lenders, $140 billion. Is that sufficient to drive the banks higher, or do you need the bond market to come with it as well? Do you need a steeper curve and higher yields from here? We'll touch base with the team a little bit later this morning on that, and we'll talk to Stuart Kaiser of UBS too. That's the price action this morning. Let's get you some morning calls. First up, BTIG, upgrading Toll Brothers to neutral without a price target. The analysts seeing limited downside at the stock's current valuation. We're positive there, 1.6% to 58.65. Your second call from Deutsche Bank, raising its FedEx price target up to 375 with a buy rating. The analyst highlighted a company's solid fundamentals and supportive macroeconomic backdrop. We're positive there, 0.7% to 293.89. And your final call from Jefferies, raising its Microsoft price target to 310 with a buy rating. The analyst expecting new and innovative products to fuel the company's next leg of growth. Coming up, investors are looking ahead to the second half, taking their positions in the cyclicals versus growth debate. That conversation up next with Nuveen's Brian Nick and Stuart Kaiser of UBS. From New York City, your opening bell is just around the corner. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
23 seconds away from the opening bell in New York City this morning. Good morning. This Monday morning, equity futures looking to build on record highs on the S&P 500, coming into a brand new trading week. 42.77 on the S&P, advancing there 6 points and up a little more than 0.1%. There's a bid to this market, a really small one, to kick off the trading week. That's the equity price action. Switch up the board and get to the bond market. What a range we saw on a 10-year yield last week. 135 at the low end. That came Monday morning. On the Friday, 154. A 19 basis point range on a 10-year treasury for the week, and yields ended that week much higher. 149.86 is where we are on 10s at the moment. We come in a little more than 2 basis points on the day. Euro dollar wants to watch a leg lower a little bit earlier. Couldn't find the reason. 119.23, euro weaker by 0.1%, and crude comes back from that 74 handle on WTI, 73.67, and down 0.5%. That's the cross-asset price action this Monday at the market desk with your movers. Here's Kaylee.
Well, John, small bid into the equity market, a much bigger bid into Bitcoin, despite a regulatory crackdown in the UK when it comes to Binance markets. Nonetheless, Bitcoin up above $34,000, and as a result, a number of crypto-tied stocks are moving to the upside as well. Riot Blockchain up 3%, Marathon Digital by about 5%, even Coinbase up by about 1%. Now, some stocks are on the back foot, though. Those include the cruise lines. The first revenue-earning cruise to depart from the U.S. since the pandemic began left from the coast of Florida over the weekend. That not really aiding sentiment, though. Investors a little bit worried about the slow return to full operations, plus concerns around the Delta variant leading to restricted travel in some places once again. So Carnival, Royal Caribbean up 2.5%, 1.3% respectively. And I just wanted to point out United as well, fractionally lower, even after announcing over the weekend it will buy more than 200 Airbus and Boeing jets. Of course, this move to the downside of around 1.5% today is ahead of its investor day tomorrow. And Deutsche Bank saying investors may be a little bit worried about that, John.
Kelly, nice. Thank you, Kaylee. Thank you very much. About 90 seconds into the session, equities advanced 0.2%. More record highs to talk about, up by around about 0.75% on information technology. Bottom of the pile, early days, the financials and energy. Financials pulling back by about 0.5%. Energy by a little more than 1%. A $6 trillion boom in U.S. equities, leaving the pandemic winners in the dust. Investors turning their attention back to the cyclicals, energy and financials leading the way with massive year-to-date rallies. Can they hold? Let's bring in Bloomberg's Taylor Riggs for more. Hey, Taylor.
Hey, John, let's take a look at where we are for the first half of the year, because believe it, we're actually sort of wrapping that up in a few days, and really growth has come back despite what was a rough, tough first quarter when there was a big rotation back into some of those cyclical stocks. Growth actually now, look at that, really trying to catch up, particularly after yields have really settled down into some of the trading ranges that we've seen as of late. June in particular has been an interesting month because that has been all growth over value, given, of course, the round trip in rates that we've seen in the last 2 weeks since the Fed. You do get a sense that there's a little bit of this defensiveness, perhaps maybe safety coming back into the market, particularly if we keep getting comments from the Fed that, well, maybe we're lower for longer, and maybe the hawks coming out and saying that they do indeed want to start discussing perhaps some of those tapering plans. Either way, John, the market is pretty bullish. If you take a look at the chart that we're showing in the terminal, boosting bets on stocks by the most ever, given what has been one of the strongest starts to the year for the S&P 500. You're looking at some of the highest futures positions that we've seen really going back now since June of 2020.
Taylor Riggs, thank you. Let's build on this. The team over at Nuveen publishing its mid-year outlook, weighing in on the growth versus cyclicals debate and writing the following, quote, "We see value in emphasizing select areas of the global equity market that could benefit from a reflationary environment such as US small caps and emerging markets." Nuveen's Brian Nick joins us now with more. Brian, let's start there. Why the global aspect of all of this?
Well, because as we're looking at the first half of the year and comparing it to the second half, it looks like growth has peaked in the U.S., both in an earnings perspective and an economic perspective. The second quarter is going to be the best quarter for growth in the U.S. But as we move into the second half of the year, that baton's going to get passed east to the Eurozone, and then we think finally to Asia and emerging markets. So if you're going to be investing in cyclicals, it makes sense to look at cyclicals in areas of the global economy that have really not reopened yet, have not gotten their populations vaccinated, have not returned to normal. That's where we think there's still value in the cyclical trade, because a lot of the surprises that we're going to get about the U.S. are behind us. We know that the stimulus was bigger than expected. We know the vaccinations were faster and more effective than expected. It's really looking forward. We have to look outside the U.S.
Well, looking at things and how they've progressed over in Europe, I'm with you on the economic data. The issue, Brian, is that the market hasn't lagged in Europe. In fact, the Euro Stoxx 50 has outperformed the S&P 500 so far this year. EM has lagged. So can you compare the two right now, EM and equities over in Europe?
So I think if you look at the kind of sort of the sector adjusted performance, the fact that the U.S. has this large tech share means it should be lagging by more, because tech has been lagging the energy and the financial sectors, as you just pointed out, this year. So we would have expected Europe to be doing even better. And as you pointed out, emerging markets have really been underperforming. I think a little bit of noise around the stronger dollar that we got post FOMC was a little bit, kind of maybe shook some nerves around the trade. But I think as we move to the second half of the year, looks like peak growth in the Eurozone is going to be in Q3. Q4 will be peak growth in emerging markets. And that we think there's going to be momentum into those currencies and into those markets from investors everywhere in the world in the second half of this year.
Let's bring Stuart Kaiser of UBS into the conversation on this theme. Stuart, I heard it from Laurie Heinel of State Street a little bit earlier this morning. I'm hearing it from Brian Nick of Nuveen right now. Do you agree with it, that this baton gets handed over from the US to Europe to EM as the year progresses?
Oh, yeah. Good morning, Jonathan. Good to see you back again. From our perspective, we have been bullish Europe, I would say, earlier in the second quarter. I think after the FOMC, we're probably a little bit less excited about the Europe trade than we previously were, just on the view that, we do think you need expectations higher on the inflation side to really get, Europe to continue to work as we move forward. And, I think the shift we saw from the FOMC was not necessarily that the rates outlook will change that much, but that the mix of rates will change. And this will be more about real rates, than it will be about inflation break-evens. And for us, that's a very important difference. It's a difference for how you invest in U.S. equities, and globally, we think it does put a little bit of a damper potentially on the Europe trade, probably a little more positive for Asia and particularly Japan.
Stu, just to be clear here, you're anticipating higher real rates, and you think that's worse for Europe. Is that right?
Exactly. Yeah. So, our view is we do expect U.S. yields higher, but that the mix will come much more from the real side than from the inflation side. And historically speaking, that is a little bit more of a headwind for Europe than it is for the U.S., and it's more of a headwind for the U.S. than it is kind of for Asia. So we do think one of the most important takeaways from the FOMC was that the mix within the rates market was going to change over the next 3 to 6 months.
Brian, Nick, your thoughts on that argument? Higher real rates, that's a negative for Europe.
I definitely agree that real rates ought to go higher and probably will go higher in the second half of the year. I think it very much depends on how you get there. We saw in the first half of the year that was not really a welcome development for equity markets, even though stocks did okay as rates were kind of shooting up. Most of that, as Stuart pointed out, was inflation expectations moving up. The big risk for the second half of the year, I think investors are turning their attention away from simply inflation risk to the response to inflation risk. Does the Fed become more hawkish? Does their response function become even more hawkish than what we saw at the June FOMC meeting with the dots? We don't think that's going to be a huge problem. If real rates are moving up for good reasons, because economic growth is sort of coming in as expected or even a little bit better than expected, that's going to be fine for global risk assets. Probably shouldn't shake up the FX markets too much. And I think Europe will continue to be hopefully incrementally more dovish on the monetary policy than the Fed, because they are a couple of quarters behind.
Brian, looking at your mid-year outlook at the moment, a lot of people might say that looks very similar to what we saw at the start of 2021. What has changed for you, Brian? And what are the signposts that you'd be looking for to adjust your portfolio, to adjust what you're recommending to clients?
Well, if we made a mistake in our 2021 outlook, it's that we weren't optimistic enough. All the surprises we've seen have been basically on the upside. We got the Senate results in Georgia that basically unlocked that much larger stimulus that we weren't expecting. The vaccines came online earlier than expected. The economic data has more or less been uniformly better than expected, but that's increasingly less common in the U.S. We're not seeing data beating expectations as soundly in the U.S. anymore. It's still doing so overseas. The Eurozone data is still coming in strong relative to expectations, as economists are sort of scrambling to catch up to this very unique style reopening. So those surprises have been, I think, extremely powerful for upward revisions of the corporate profits outlook and upward revisions to the GDP outlook. I think they're probably over in the U.S. I think there's still a lot of surprises to come, especially in EM in the second half of the year.
Stu, just one more for you. The same question to you. What's changed for you in the last 6 months, through the first half of this year, as you look to the back half?
Look, I think the big thing that's changed in the last month, for instance, has just been that the Fed was paying much more attention to that inflation data than we necessarily gave them credit for. I would agree with Brian. I think the data cadence has been much faster than we would have expected. Growth has probably recovered a bit faster than we would have expected. So I think, that does change, I think, the sequencing. I sort of agree with the view. You want to be long cyclicals. Our view is just that because of the FOMC, the way you own those cyclicals has shifted a bit. has probably got a little bit more towards, cyclical parts of tech like semis and a little bit more towards banks relative to the commodity sector. So, big picture, our view, I think, is pretty consistent that, growth is going to continue to accelerate. Inflation is going to be transitory, things of that nature. But, I think the FOMC has added a wider range of uncertainty around that baseline outlook.
We'll talk about what that means for the banks in just a moment. Stuart Kaiser of UBS, Brian Nick of Nuveen. Your equity market just adding a little bit of weight to the S&P 500, 42.82. Record highs on the cards once again. At the market desk with your movers is Kaylee.
A little bit of weight at the benchmark level, John, but there are some big movers beneath the surface, specifically in the biotech space. The big standout this morning is Intellia, surging around 46.5% after a gene editing study by the company showed early signs of promise in treating disease inside the body. That's giving a lift to some other gene editing stocks as well. CRISPR up 7.6%, Beam Therapeutics up 17%. I would also note it's giving a lift to Cathie Wood's ARC Genomic Revolution ETF, which is a top holder in a few of these stocks. We do have some stocks in the red to note, though, John, one of them being Boeing, which is running into some trouble with its 777X long-haul jet, facing additional testing and delays because of the concerns from the FAA around a test flight incident, software data issues. As a result, that stock is down a little more than 2%, dragging on some suppliers as well, like Spirit Aerosystems, which is off by 3%. And I just wanted to note in space,